Okay, well, welcome everyone again. Thanks for joining us on this nice long weekend Saturday. Appreciate everyone taking the time to join in for the Razor Energy and Wescan deep dives today. This is going to be run very differently than the usual valuation sessions. With companies like this, it's not the near-term cash flow or what they're making today that's really important. It's kind of looking into, okay, what can this company do in a year, in 6 months, in 2 years, in 3 years? As many of you know, we've had a lack of capital in the space for, probably you can say 8 years, but a lot of companies have not been able to put the proper capital in for 10, 12, 15 years. A lot of these fields have just been ignored while people go and target the Permian and the Montney and the Duvernay and whatever else. So a lot of the lower producing wells, 10, 15 barrels a day, they just been ignored because people don't care. They say, well, if I can go and drill a Montney with 700 barrels a day, why am I going to waste my people and my employees on trying to optimize the 15 barrels a day or the 5 barrels a day? So an opportunity has now come up with oil trading above $100 and possibly headed higher in a structural market that you can make a lot of money by optimizing, putting some TLC and giving some love to these little wells all over the place. And they make a ton of cash because they're already drilled. They're already got tubing in them. They already got casing in them. They already have pipelines. So you don't have to do anything as far as any surface work or anything like that. So some of this stuff only becomes economic at $80, $90, $100 oil. And these are two that I came upon in the past a little bit. So yeah, thanks again for joining. Just want to say I'm not an investment advisor, so anything I share today is strictly my opinion. It's stuff that I've seen and that I use in my own investment mandate, if you will, and just sharing my due diligence process, what I look for, things that I've noticed, stuff that maybe the market doesn't appreciate, but I do, and I think is setting these companies up very nicely into the future. So please do your own due diligence as well, verify everything, check your own risk tolerance in your portfolio, make sure you're comfortable with the thesis here and your investment time frame. Not everyone has a time frame that I do, so you might be a shorter time frame, longer time frame. So yeah, just keep that in mind. The other thing, so just give me sorry about that. So where was I? Yeah, so okay, so the previous valuation sessions are on the website, whitetundra.ca, under events, archive seminars, along with the macro. They're also on YouTube. So if you're looking for more kind of content, check that out. I also have price targets on there now. I will be updating that sheet on Tuesday with all the new ones. So Cardinal, ROK, I believe, like there's 10 or 15 of them missing. So I'll get them on there based on the eight times free cash flow model. The recording of this one, again, will be posted by the evening. Again, for anyone on Twitter who wants to join for the visuals, please check out the Zoom link on the website, whitetundra.ca. And then lastly, feel free to contact me. My contact information is on the website. So if there's any questions, you want to discuss these two names or anything else, give me a shout or email me and we can go from there. I also have a mailing list for the Zoom links and the files that I look at. So if anyone wants to get on there, I don't share much except the Zoom links really and the files. So if you would like to get them, shoot me a message or an email and we'll get you on there and we'll get started here. So Razor Energy, we'll get started with that, with this name. It was highlighted to me a few times by various different people in January, February, I believe. Never really thought much of it because it was so convoluted to try and understand what's going on here. They got all kinds of stuff going on. Um, but that's where you find opportunity. If you're willing to put the work in. At that time, I had more conviction in some of the public names. I didn't have time to really focus, but now that I've had time to look into these, I think it's been some interesting things I've found. So we'll get started with this one and then go into Wescan. So the main info, I'm not going to go through the cash flow valuations or anything like that. People know really the way I calculate the free cash flow yields and whatnot. So I'll leave that for the presentation. This will be strictly due diligence. So net debt is about 113 million after their recent financing. Market cap is 75 post dilution after the recent capital raise. So about 200 million, let's call it, of enterprise value. And they barely make any money. At 77 WTI in Q4, they only made $9 a BOE because the operating expense is through the roof. These are old fields. These are very, very old fields drilled in the 1960s and the 1970s. So you're spending a lot of money on maintenance, repair work, etc. The royalties, it's roughly 20% here, but they will go up to 30 and up to 40%, I believe, because these are older fields. They have no royalty breaks or anything like that. So yeah, just keep that in mind. There's a lot of near-term cash flow issues, but when oil prices are rising, the companies that are going to give you the highest torque are the companies that are barely making money. So if they only made $4 million of net back at 77 WTI, that means that if WTI is at 87, so $10 above that, you're doubling your net back. So your profitability, pre-tax and all that is doubling. So that's the companies that I really started to target, because for companies like Whitecap, Crescent Point, whatever, the rest of them, they were already making $40 a BOE at $70 WTI. So if WTI goes up $10, their net back goes up 20%, which roughly reflects in the share price. But companies like Razor, when WTI goes from 77 to 87, the operating netback doubles. And you kind of see that reflected in the share price in a way. Like the share price tripled in a week and it stayed there. It hasn't gone down. So it's found a better base now that people understand the company, and now that the netbacks are obviously higher. Q4 was 77 WTI averaged, Q1 was 95. So we could have potentially roughly tripled our operating netback from Q4 to Q1, which again, people are not paying attention to that. They're posting Q4 numbers and saying, well, this company's trash. Well, okay, well, if you're tripling the netback and Q1 is already in the books, it's not like we're guessing as to what's going to happen. We already know WTI averaged $94.80 roughly. So we already have the data. All you have to do is a simple calculation as to what's happening. At 100 WTI, we get roughly 48 million of netback. So the 4 million multiplied by 3, 12, and you annualize that, that's 48. Roughly is what we have. So that's netback. After that, you take off the G&A, you take off interest, you take off the taxes. You end up with 30 million, let's say. So the free cash flow yield is not great. Even at 100 WTI, it's only 15, 18%. Doesn't really compete. But again, if you think WTI is going to go to 120 or 130, other companies might get a 30% boost to their netback or 40%. Razors is basically going to double from 100 WTI to 130. It's going to double again. So the upside torque is in this name. Production for Q4, about 4350. They did another acquisition there in August, and that got added in there. They're doing some reactivation, so 4300 is where we are. Q1, it's already at 4750. So there's another 400 BOEs coming online, and that's basically pure profit, because A lot of the operating costs for these companies are fixed. They have to pay the operator. They have to pay the processing on their facilities. They have to pay the transportation cost. They have to pay interest. It doesn't matter how much you produce. Those are fixed costs. You're running your engines, you're running your field equipment, etc. So this extra 400 BOEs, basically the net back on it is going to be much higher than the $9 that they got in Q4. Not just because prices have come up, but also because, again, the fixed costs are the fixed cost. The variable costs are much lower. So every BOE you bring online additional makes you a lot more net back per BOE. So a better way to explain that would be, let's say you have a facility that can handle 10,000 barrels a day and you're only producing 1,000, okay? So you're spending the power, you're spending the labor expenses, you're spending the maintenance, all the expenses to keep your little facility running for only 1,000 barrels a day. If you start producing 1,500, well, your fixed costs don't go up, but you are now producing way more barrels out of the same facility. So if you used to make $9 a BOE, you will now make on average $12 or $15 a BOE. So just keep that in mind. The extra production is adding to the netback in a bigger way than the existing production. The well reactivation inventory, they spend roughly $125,000 a well. They make 32 BOEs, low decline, very fast payout. These capital efficiencies that they're giving you are industry leading. A lot of companies are doing this reactivation thing. ROK, Saturn, Crescent Point even, Razor obviously. These are some of the best capital efficiencies out there with some of the best decline rates. You want low declines on them because you don't want to reactivate the well and then it starts declining and then your entire production base is hard to maintain. So that's a great sign. On the power generation, they've got 9 megawatts running of power generation, which is saving them $500 or $500,000 a quarter right now. They got another 17 megawatts coming online in June, July, August. It'll save them another $1 million a quarter in operating expenses. So because of the area where this is, Razor spends about $10 a BOE in just electricity cost, which, as you may know, has skyrocketed in the last year or so. It's more than doubled. For anyone running electricity to their houses, you know this. So they're spending $3.5 million a quarter just in electricity, and that's why these power gen projects are really good, because they save them money on their actual operating expenses, and they're a fixed asset that's worth something, and they're getting a bunch of credits for them from the government. So it's a win-win-win. And after these two, they'll have roughly 26 megawatts. The valuation we're giving to producers like Journey, some of them in the States, is roughly $2 million a megawatt. So that's $50 million of asset just sitting there, which some people subtract that from the enterprise value, some people don't. You're free to run it as you wish. I'm just giving you the data of what I think it's worth. Yeah, so to generate the electricity, it's a lot of geothermal. They're pulling hot water out of the ground and using the heat off it to generate electricity, and a little bit of natural gas as well. Yeah. They also have a soil remediation business, which it doesn't really add anything to the funds flow really, but it does provide a good hedge, because with these older fields, they're liable to corrosion issues and leaks and spills. I've worked in some of these way older fields, and you always have corroding pipelines and issues, and you try and maintain it as best as you can. But when you got wells all over the place, spills do happen, leaks do happen. So the fact that they have their own soil remediation means they can take any dirty product, take it there, extract the oil out and sell the oil, but also not pay a bunch of disposal fees and processing fees, which do add up. For anyone working in the oil patch, you know, you get price gouged on these disposals and remediations. It's a cash cow running these businesses. depending on where they are, obviously. But yeah, so these are some of the positives coming out of it that maybe are not reflected in strictly looking at the cash flow statements. We look at the hedging situation. They've got pretty cool hedges here. So a lot of companies are losing a ton of money on hedges because they want these cost-free collars and all this other stuff, which is great because you don't pay any money up front, but then you end up getting absolutely railed on hedging losses. So like, what's the point, right? You're basically, it's the opposite of insurance in a way. You'd rather pay more upfront and then get the benefit of it. But what a lot of companies are doing are choosing not to pay, and then they get just thrashed on these hedging losses throughout the year. So the way Razor has them structured is that they have a long call instead of a long put, or instead of writing calls as their top as a top method, they actually buy the calls. So what that means is the maximum loss they can get is WTI minus the difference between these two. So WTI minus 10, that's the maximum loss they can get on their hedges, which I think is a great way to do it because you have a floor and you have a ceiling still, but you also give yourself optionality on the upside by giving up this $10 premium, which is just fantastic. They don't have enough barrels hedged to really make a difference, but it just goes to show the thinking of management and how they're coming up with the situation. People have been using three-way collars forever, and they've been losing money forever. They've also gained money on them, but they've also lost money forever. So this is a fresh idea that they brought up, and it's cool to see. Like, I think a lot of companies might move to this, depending on their macro outlook and their conservativeness on it. They also bought call options for oil. So in February or January, they thought the pricing for oil was going to go up. So they ended up just buying calls on oil. Resonates well with the Canadian oil investors on Twitter, because this management team seems to understand what's going on here, and they're very aggressive on these contracts as opposed to losing money on them all the time. Okay. Dividends. So Razor actually had a dividend in January 2020 before COVID hit. They actually went in and put a dividend, 1.25 cents a share. So that's 15 cents a year monthly, or 1.25 cents a share monthly, which is 15 cents a year. So that's about a 5% yield, which they were comfortable doing that in January 2020. So anyone saying that this company has debt issues and they're got problems and they might go bankrupt, yeah, that's definitely not the case as far as I see. They're partnered with AIMCO, very, very supportive lender, and Arena, their other lender, can't take them bankrupt. So again, something that people don't understand, or they're not putting the effort into. The way Arena's loan works is if Razor is not compliant with that loan and they can't pay it back, Arena basically gets a perpetual, so a forever 10% royalty on Razor's production. That's it. Arena can't go and take the company bankrupt. They can't go and ask for the money back right away either. There's a lot of stipulations on when they can demand the money. And if Razor chooses and they don't want to pay back the loan, they just give them a 10% royalty forever. And that's that. The loan is done that day. So where's the bankruptcy risk? In my opinion, there isn't any. It's just not going to happen. AIMCO is also not interested in taking over these assets and running them, because they're not a production company. They're a bank / investment fund. Again, all of this is just my opinion. Some people might still think there's a bankruptcy risk, and rightfully so. So it's up to your own interpretation of what's happening. In my opinion, there is no bankruptcy risk here. The loan that's convertible to 10%, that is, I want to say it's up to $40 or $50 million now. That was what was used to fund the power gen. They recently took another 12 million US out of that a couple months ago. So I think it's up to 40 or $50 million now. It's around 10% interest or 12% interest on it. But yeah, these sorts of things, I like to see these things from a management, because I've been publicly complaining about management not understanding the macro and not positioning themselves good for the upcoming structural market. This seems to be a management that sort of understands what's going on and is also walking the walk, which is great. Because when they do a $5 million financing, like they did here a couple of weeks ago, and it's still active, I'm more willing to give them the benefit of the doubt that this $5 million is going to be spent the right way, because they seem to be positioning themselves for doing the right things. This is Razor's assets. So they got the K-Bob unit, they got Virginia Hills, and then the 3 Swan Hills units. The South Swan Hills is 90%. 10% is owned by Conifer Energy. The Swan Hills Unit 1 is 49%. 51% is owned by CNRL, Canadian Natural Resources. So what's going on? Where's the potential? So I'm going to ignore this geothermal, the waste management, and the produced water, because I don't really have any idea what the upside is there. And I'm going to focus on the carbon capture potential and the EOR potential, the development drilling here in the East Swan Hills, South Swan Hills, and the K-Bob units, and then the Virginia Hills restart, East Swan Hills waterflood. That's where the potential is. All of these fields were drilled in the 1960s and the 1970s. They've been producing forever. And I'll show you here why the upside potential in these fields are amazing. But again, like I discussed at the beginning, no one really cared. They said, screw these fields. Like we'll go and drill Duvernay's and Montneys and get the oil sands going and produce hundreds of thousands of barrels a day. Why bother with these 15 barrel a day wells? That we got to deal with day in, day out, issues with production, etc. So they've been ignored. They've been ignored for the last 15, 20 years. And now that oil is where it is, that's where opportunity lies. Why is CNRL active in this area if fields are so old? CNRL has a really good knack of picking up certain assets that people don't appreciate at low pricing, and they know they can make money off it in the future. So yeah, keep that in mind. So let me begin by talking about the CO2 flooding, because the CO2 injection is something I've been discussing on Twitter Spaces, and as a potential for what will be the big technological advancement here in this oil boom. We had the shale in 2008, 2014, hydraulic fracturing, and I think the CO2 flooding is really going to come back here as we go. So how does it work? So this is the reservoir, so the well before we drill into it. There's the yellow is the oil, the blue is the water, and that's how it sits. The rock is oil wet, which means that oil is more attracted to the rock than water is. So it's the oil that's the majority in the reservoir, and it's the oil that's clinging onto the rock. So how are you going to get the oil out? Well, you have to have the oil prefer to leave the rock than to be stuck to the rock. And the oil likes to be stuck to the rock. It's been sitting like that for millions of years. So what are we going to do? The first thing that we do is we just drill into this rock and we let it flow. So why would the oil move? Because the underground pressure is like 1,000 kPa, is 5,000 kPa. It's pressured up, so the oil sticks to the rock. But when you drill into it, you depressurize it. You give it a way to flow into a lower pressure zone. And any fluid, any gas likes to flow from high pressure zones into low pressure zones. is just the natural state of things. So the first way to produce oil, we just drill into it and we let it flow to surface, which is a lower pressure, obviously, than downhole. Okay, once that's done, we can inject water. So I've talked about water flooding. And what the water does is it actually pushes the oil. So you're not just relying on the natural high pressure to low pressure movement, you're actually pushing the oil from an injection well into a production well. So you inject water, look at the arrows, it pushes the oil into the production well, and you maintain pressure in the reservoir. So, okay, we do our water flooding. What is a typical distance of injection to production well? There's all sorts of ways you can run them. You can put injection wells in the middle of a few producers. You can put injection wells around a few producers and try to push it into the center. You can run like fields, kind of like a football field, where you have 4 or 5 injectors in a row, all pushing into 4 or 5 producers in a row. That's reservoir engineering stuff, very complicated simulations and downhole studies and whatnot. And I'm just not smart enough to tell you what the answer to that is, but there's all sorts of ways that they do these things. But once we're done the water flooding, you see what's happened here. The oil that's stuck to the rock, like right stuck to the rock, stays there because it still has more of an affinity to be attracted to the rock than it is to flow anywhere. It's been sitting like that for millions of years. Why would it change? So what do you do now? Well, water is immiscible with oil. What that means is when you have water and oil, they're never going to mix. They're never going to become one phase or one entity. The water is always going to be just pushing the oil. It's never going to go in the oil, which is a problem because the oil loves sticking to the rock. It's just going to sit there. It's been there for millions of years. It doesn't care if it has to do it for another 100 of millions of years. It really doesn't care. So what you do is you inject CO2. So why CO2? Because CO2 actually goes in the oil. It makes the oil lighter and it separates it from the rock and allows it to flow. So this is what you get with a CO2 flood. The oil that was sticking to the rock, the CO2 goes in the oil. It makes it lighter. It makes it more interested in flowing and leaving the rock, and it goes into your production well, where you produce it, and then the money goes in your bank. Okay. On the left side here is the diagram of how it works once it's running. So you have the CO2. You have like a miscible zone. Miscible being that the CO2 goes in the oil in this zone. Then you have this big oil bank that you've accumulated, and you're pushing the whole thing into your production well. The reason you inject water after CO2 and you alternate is because CO2 has a tendency that once it goes into some oil, it'll pick the path of least resistance. So it'll just flow it from these open areas. So you jam CO2 behind it. That way the CO2 can't escape because the CO2 can't go through the oil. So you have these walls of CO2, then you get the walls of water, and you just keep doing this forever, basically. Keep pushing more and more and more oil. This diagram on the bottom is not how it works on the first run. On the first run, you're going to get a few droplets of oil from here. Then on the second CO2 run, you get a little bit more and then a little bit more. So it's a gradual process over 10, 15, 20, 50 years. The other question I often get is why CO2? Why not nitrogen or methane, or why not just pump fresh air down there because it's cheap and free? Well, CO2 is miscible in oil, as in it can go into oil at a very, very low pressure. So your downhole pressure doesn't need to be very high for the CO2 to go in the oil and push it, or bring it with it, if you will. Whereas nitrogen and oxygen and all these other gases, they need way higher pressure to be going into the oil. Okay, so there are lots of questions here. What is the source for the CO2? So I'll talk about that here later. The point I'm trying to make here is what the CO2 injection is, because I know I'm going to get lots of questions about this if I don't explain this properly here. Is CO2 flooding basically soda water injection? Yeah, basically, yeah, you're right. Yeah, interesting way to put it. Polymer and CO2 could be done together. Yes. Does the injected CO2 come back up with the oil? Not all of it. A bunch of it gets sequestered, which is where the whole carbon sequestration thing comes in. So I'll talk about that here as I go. So, okay, so that's that on the CO2 flooding part of things. I don't think there's anything else I wanted to talk about here, but I'll leave the chat open if there's any questions as we go on that. Yeah, okay. So what's the nice thing about Razor? The biggest issue with CO2 injection is we don't know if it's going to work. We just don't. Until you try it, you don't know if it's going to work. Well, the Swan Hills property that Razor took over already had a pilot done. They had a pilot project done in 2010 by Penn West, which threw all kinds of money at it. They spent $40 million. Again, Razor is only worth 200. So keep that in mind. They've got 40 million of data and equipment sitting here. 20 million of that is the facility right here, which you can see. And 20 million was used to truck in CO2, which is uneconomic. So Penn West couldn't make it economic, but they proved out the concept. So here we go. This is the battery, which is the facility where the CO2 oil came into. So you can see that it was producing at, this is the oil rate here in green. It was producing roughly 140 barrels a day. It was declining, 10% a year, 10, 20% a year. We shut down for about a month to put the CO2 stuff in place. And you can look at the oil response here. It went from 60, 80 barrels a day to almost 180 in 3 months. They only got 3 months, unfortunately. So we never got a full trial for a year or 2 or 3 because trucking CO2 just got so expensive. But the result is obvious. There was an impact, and the impact was right away. So run the same thing over many, many years, and you push more oil as you go. You liberate the oil, and then you use the water to push it. So, this well could have made, or this facility could have made way more oil if we just had time and CO2. Here is the well, the production well that the CO2 was injected towards. You can see it was making 40 barrels a day, declining to about 30, 35. And within 3 months, we were back up to 55, 60 barrels a day. It's that quick, and it works. We don't have extended trials, but you have a trial, you have a battery, and you have a well, and we have a second well that was a non-decline well. So it was basically at its end of its life, it was making 30, 35 barrels a day. And within 3 months, within 2 months, it started making 55, 60 barrels a day. So we have 2 wells. This study that was done by Penn West, no one is paying attention. How do I know this? Look at the annual report. This is like a 100-page report that tells you everything about this project. It's had 52 downloads in 10 years. In 12 years, it's had 52 downloads. And I'm probably 10 or 15 of them. So no one is paying attention. I can guarantee you that. And I have the number right here to prove it, that people just don't care. People want the big, sexy Montney wells. They want the big, booming gas wells making 10 MCF a day. All this stuff has been ignored. And Razor's come in, they've scooped it up. They've got an aggressive management team. They've got the ESG component, and they're working on it. It takes time. Looking at stuff that's 10, 15 years old, we don't we don't just switch them on in a snap of our fingers. It takes time. It takes a year. It takes 6 months. So from this report, for anyone interested, it's a free report on the Alberta government website. You can go and download it, read the entire thing of what they did, the engineering behind it, everything else. Here's the 40 million I was talking about. It's $36 million that they spent on the South Swan Hills project. And look at this comment here. Productivity of the wells was initially underestimated. It is possible that the CO2 is mixing with water and creating a weak acid that stimulates carbonates. So it actually is almost like a fracking / acidizing operation, stimulation operation. The higher productivity also suggests that the existing geological model is underestimating the reservoir permeability. Talk to any reservoir engineer, they will tell you that the biggest issue with water flooding and CO2 flooding is having the right permeability in your reservoirs. Their existing model with 50 years of data was underestimating the permeability. Higher productivity wells could result in oil response profile exceeding forecast expectations. Why would they say this to the government? Right? They're saying this to the government because they actually believe this. They think this is going to happen. The best thing to do with the government would be to underestimate everything and have them not tax you, not have to give you lower royalty rates, etc. You underestimate everything, but they're literally telling the government, like, look, these wells are going to perform. Like, if we had a source of CO2, we could make a ton of cash here. That's exactly what they're saying. Interpret that as you will. I think it's a really positive sign moving forward. Something that only 52 people have read this exact paragraph, and the 140 that's on this call now know this. Yeah, I'll leave it there. Stuff has been ignored for a long time. The information has been lost. The knowledge has been lost. People who were working on this project have retired. They've moved on to different things. They don't care anymore. So we're kind of starting fresh, but we have a lot of things to work with. That's positive signs for the future. Okay, so let me talk about the actual fields now. So Kaybob Unit 1, right by Fox Creek, easy access to people, machinery, equipment. The electricity grid runs right through this field. Anyone that's worked in Fox Creek knows it's just a mess. Like, the roads are a mess. The getting equipment out is a complete gong show. It's very rough terrain. Roads way deep in the bush with no access to cell service, nothing. So having these two fields right by Fox Creek is great. It's really awesome. The link to the document I discussed in the last page here, it's on the Razor corporate presentation. So if you open their presentation, go to the CO2 page. On the footnotes, there's a link right there. So if you want to view it right now, check that out. Thanks, Diogenes. I3 are doing water flood and CO2 flood too, potentially. I haven't looked into them closely. Yeah, so the link for that is on the chat for anyone that wants to open this page. Anyway, the Kaybob 1 unit right here was producing up to 10,000 barrels a day in its peak. It's now producing 75. Okay, just keep these numbers in mind because I'll tell you why they're important as we go here. It was producing 10,000. It's now producing 75. This is a 50 to 60 year chart, so don't get confused. It's a long time frame, but it went from producing 10,000 to 75. The water injection, this pink line, was shut off about 15 years ago. They completely shut it off. And I just explained earlier what happens when you shut the water injection off. You basically stop producing oil because you're not giving it the push, you're not giving it the pressure support. So why did they shut this off? They didn't care. They didn't have the money. They some went wrong, blah, blah, blah. It got left. Okay. Doesn't matter. The point is, if we inject water now, what could happen? That's the question you got to ask yourself. If we restart this water injection, we were producing 500. When we had the water injection maxed out, we were producing over 1,000 barrels. So you could 15x your production potentially just by increasing the water injection, potentially. Okay. You also see that this field hasn't been properly drilled. They've got all these suspended wells and active wells, but there's a bunch of open land here that's part of the unit. This orange box is a unit that hasn't been drilled. So again, potential upside with existing water injection wells already in the area, existing facilities already in the area, existing processing equipment already in the area. You're not spending any more money to build anything. You're just using what you already have. It's like going and filling your gas tank. You go to the gas pump and you fill 1 liter at a time. Okay, it works, but it's not really efficient. And if you started filling more, you would actually save money and it would be way more efficient. That's the same point I'm trying to make here. They're running a 10,000 barrel a day facility at 75 barrels a day. The KBOB 2 unit, even closer to Fox Creek, it was producing 10,000, 8,000 at its max. It's now producing 150. The water injection has stayed steady, but again, hasn't really been given care and maintenance. Virginia Hills unit is totally shut down. It's making like 20 barrels a day. And look what's happened. 15 years ago, it was making 3,500 barrels a day, BOEs a day. There was some sort of pipeline issue and they didn't even bother to fix it. They just lost 1,500 BOEs right there. And then the decline was only 10% for about 7 years. 2014 hit and some other pipeline issue happened. They lost another 1,200 BOEs a day and they just shut it down. They didn't care. They went and started drilling some other thing. So the wells are already there. There's just pipeline issues here. You get these 2 pipelines back running. You spend $3, $4, $5 million. I'm not sure what they got to spend, but it's only a pipeline issue. It's not like some blew up or, there was an explosion or something. Like, it's just pipelines. It can be fixed. This is cookie cutter stuff in the oil patch. If you give it enough time, you give it enough manpower, you throw people at it, you throw enough engineering at it, you can fix it. So you fix 2 pipelines, you can get 2,000 BOEs back. Razor's only producing 4,750. You do the math. You fix 2 pipelines, you increase production by 40%. Same thing as KBOB 1. The water injection was shut off about 10 years ago. What happens if you bring the water injection back on? This field used to produce 10,000 barrels a day. That's a green line, by the way, oil. It started declining and then no one cared and it's down to 75 or no, it's down to 20 barrels a day. Lots of upside, right? That's the point I'm trying to make is there's lots of upside. 2014 hit, they didn't have the money. Oil price went to 30, 40, 50 bucks. No one cared. It's been sitting there for 6 years, 8 years, more than 8 years, almost 10 years now. The oil's there, the wells, look at how drilled up this field is. The wells are there. Everything is there, ready to go. You just need to put a little bit of money into it and get it going. South Swan Hills unit, the Big Daddy. This was making 80,000 barrels a day at its peak. It's now making 500. So lots and lots of upside here. This field has not been taken care of. Whoever owned this, they just left it to die, decline. Whenever a well went down, they said, whatever, screw this, like leave it down, just suspend it. Yeah, now we have time. Razor has time. Razor has the money. They've got the right people. They've got the right geologists and engineers. and field operations people working on this. For anyone who knows Doug Bailey at Razor, he will reply to your emails at 11 o'clock at night. He will reply to your emails at 4 in the morning. And he's always in the office. Every time I call him, even if it's at 8 p.m., he's always in the office. This guy is addicted to getting this production back online. You may think that's a negative. You may think the guy doesn't have a life. For me, as an investor, as an engineer, as a petroleum engineer, I love chatting with him because he understands what's going on. He understands the upside here, and he's working hard to make it happen. So, you know, I will personally vouch for Doug. Swan Hills unit. This is 50-50 with CNRL. Used to produce 100,000 barrels a day. It's now making 3,000, roughly. What else can I really say? It's the same thing. They've got 5 or 6 or 7 of these monster reservoirs that have not been taken care of. This is probably the biggest one with CNRL. I believe the original oil in place is about 2 billion barrels. So it's huge. Like, this thing is a monster. And there's no wonder that CNRL wants the 50% and operating stake in this. Again, partnering with CNRL may not mean anything to a lot of people. To me, I know how CNRL operates. They look for these fields that they can sit on, and when the time comes, they can jack up production by putting the right money into it and the right efficiency, the right capital efficiencies. There's a reason they're holding on to this field. So, keeping that in mind. East Swan Hills unit. This is the kind of like a newer unit. Not as much production, but it only used to produce 10,000 and it's now at 100. This is probably the field with the most upside to just drilling. You don't even need a CO2 source. You don't even need horizontal drilling. You just jam vertical wells in here, infill drilling, and you can get like 40, 50,000 potentially if you can really use the field. It never produced the max rates that the other fields did. It never got the right development cycle to produce those 50, 40,000 barrels a day. So it's still very early in its recovery phase. There's a lot of upside here just from the original drilling, let alone the EOR and the water flooding and all that. Looks like there could be some flush production after a decade of not producing, says Razor Alex. Some of these wells have been in suspended status for 30 years, 40 years. Flush production, yeah, it might as well be a brand new well if they can reactivate them properly. Weyburn, one of the only running CO2 floods out there today. Primary and water flood, they produce roughly 20% of the oil in place. All of the fields I just talked about are in this primary and water flood phase. Cenovus / Pan Canadian was smart with the Weyburn field. They started doing extra vertical infills and horizontal drilling in the 1980s. They got production back up. And then they started their CO2 injection in 2002, early 2000s. And they were able to increase production even more. This is the one graph that really matters. This is the only running example other than Midale, and Midale is the exact same, that proves to you that this concept works. So CO2 has extended the life of this field for another 30, 40 years. Where are we in this cycle in the 5 or 6 fields I just discussed? We're right here, this blue line. We haven't even done these horizontal infills. We haven't done the pre-CO2 vertical infills, some of the optimizations. We haven't done this. So we're sitting, like I showed you, fields that used to make 40,000 a day, just like Weyburn, now producing less than 1,000. That's the blue curve here. That's where we're sitting right here on these 6 or 7 reservoirs. So when you ask me what's the upside, we could 20 times the production out of these fields. So they're currently making 4,000 barrels a day. Best case, again, this is best case. You know, I don't want to throw numbers out there because people start calling me crazy, but the graph shows you what happened. When you put the right money in, you have a CO2 source, and you build it out. That's possible. And the nice thing is that with Weyburn, they already were working on these CO2 or this production enhancement stuff before. So the CO2 flood, yeah, it increased the production. It helped a lot. And it was still a massive technological advancement, but it wasn't that huge. Like they basically doubled production. When in the case of Razor's fields, they haven't done this yellow chunk. So we're sitting right here, making nothing out of a field that used to produce this and has the oil in place to produce this potential. The potential here is crazy. Okay, so there's 3 comments here, all saying that we don't have the capital, we don't have the CO2, and what's the timeline, etc. Right? And you're exactly on the right track. That nothing I'm saying here makes sense so far because we don't have CO2, and we don't really have a timeline for this, right? The point I'm trying to make is, the first point I'm trying to make is that Razor has this potential. Other companies do not. They don't have fields that respond well to CO2, or they've already done a lot of work in this orange box here, like Crescent Point, Whitecap, Vermilion, Baytex, all these mid-tier producers. They've done a lot of infill drilling. They've done a lot of optimization, etc. So this orange chunk is already gone, is already being produced. In Razor's case, it's not. And B, Razor has the reservoirs that respond well to CO2. We already have a pilot that proved it, and we already have $18 million of equipment sitting on site, okay? We need to get that agreed upon first before we start talking about how are we gonna get the CO2 there. But hopefully I've made that case. Weyburn, they pay $20 a ton for their carbon. It comes in from North Dakota, it's piped in. They're producing roughly 20,000 barrels a day. That equates to roughly $5 a BOE. They inject 5,000 tons of CO2 every day. That's $100,000 a day. They make 20,000 barrels, so they're paying $5 a BOE. 100,000 over 20,000, $5 a BOE operating cost just for the carbon. When oil is $40, doesn't make sense. When oil is $100, makes a ton of sense, especially because you don't have to drill anything. You don't have to change anything. You just go in, you change out the tubing, you watch for your corrosion because of the CO2, and you produce. You don't have to drill anything. You don't have to create new processing facilities for the most part. You don't have to work on geology, buying land, doing surface stuff, nothing. The wells are already there. The oil is already there. It's just stuck to the rock. You have to convince it to come and produce into the producing well. So I'll talk about the CO2 here in a couple slides. I want to talk about the reactivations for a sec. This is what the average well looks like that hasn't been shut in. So the average well in these 6 or 7 fields I talked about that hasn't been shut in looks like this. It used to produce 600-700 barrels a day. It came down to 70, and it's been producing at like 50 barrels a day forever with the water flood support. What if you put a CO2 into here? Can this get back up to 100, 200 barrels a day? Potentially, yes. I should have taken screenshots of the Weyburn wells. Error on my part, but I will share those as to how this changes after CO2 injection. These are the shut-in wells. The wells that got suspended, and the company previous to Razor never bothered to bring these back online. They were producing 300-400 barrels a day. It declined to like 50, and then bang, it was down. No one cared to fix the pump or fix the tubing or fix the sand issue or whatever was going on. No one bothered. You got at least a 50 barrel a day producer sitting here, maybe more. I would bet it's going to come on at way more than 50 barrels a day, given its production history, the way it looks here. Something obviously went wrong here. And then there was a second issue where the decline, like it just declined 80% in a year or whatever happened here. These are the reactivations. So if you look at this well, it got shut in, it went to 0 in like 2019. They brought it back on at about 50 barrels a day, and it's producing at 50 with almost 0 decline. That's exactly what they tell you is going to happen. And I'm pulling out wells. I can pull out 50 of these that show the exact same trend. Here's another one that was shut in like 2017, declining, and look at where it came on. When it got shut in, it was at 7 barrels a day. It came on at 30 barrels a day. It has since declined. I think there's a field problem going on, but I'm going to monitor this well, and I bet you it comes back up here to the 30 barrels a day mark. So when it got shut in, it was making 7. It came on at 30. That's called flush production, and it likely stays there given how long it's been shut in. Okay, so what kind of wells does Razor have? Like, why do I keep talking about these reservoirs being so good, and you know, they've got the best reservoirs and blah blah blah. You know, look at the oil production out of single wells. One well in the K-Bob or the Virginia Hills has produced almost 8 million barrels on its own. These are monster wells. These are monster reservoirs. There's only a few of these. If you know Alberta, you know the Leduc, you know Nisku, you know Keg River, some Imperial Oil stuff, Husky's old stuff. That's what these are competing with. These reservoirs are world class, and people are not paying attention. I'll put myself out there and tell you, if you look at the top wells in Alberta, excluding Leduc, Nisku, and Keg River, and maybe the Fort McMurray stuff, these are the top wells. That's fact. There's nothing else really that competes with this. And if you put water flooding in here, if you optimize them, if you put CO2, yeah, there's some big potential here. This is Conifer Energy, which is just south. I'll show a map here of Conifer, where they are. They've got the best wells in this area. Upwards of 10 million barrels a day produced out of single wells. And Conifer is going to be a strategic partner for Razor, which I'll talk about again here in the next couple of slides as to why. Yellow is Razor, orange is Conifer. You can see why I'm talking about this. Like these wells, like these 7 or 8 or 10 reservoirs I show you here are historic. They haven't been produced properly. They haven't been engineered properly. They've been ignored. They've been just left to die, you know, whatever, screw this. We're gonna go drill better wells, you know, new wells. We want our production maxed out. I've been talking about this before. Anyone that invests in oil knows this. From 2010 to 14, the big game in town was production. We wanted to maximize production. Management got paid on how much they could jack up production. So they didn't care about 5 barrel a day wells, 10 barrel a day wells. They wanted to drill big shale wells and get the production up so they can get their massive bonuses and retire. So now that the name of the game is cash flow, you want to be in companies, not you want to be in companies, I want to be in companies that have these fields with insane cash flow potential. Just my opinion. So why Conifer? Why do I keep talking about Conifer? Look at Conifer's website, what they tell you. They're a new entrant to the Canadian marketplace, blah, blah, blah. They produce 7,000 BOEs, yada, yada, from the best reservoirs in the province of Alberta, not just for recovery, but for future carbon capture utilization, and storage potential. Conifer just bought these fields like 18 months ago. They're focused on CCUS. They're focused on CO2 injection for recovery. I can tell you, Conifer is working on bringing a CO2 pipeline to their field right here. If that CO2 pipeline comes into this field, I don't know what the source is. I don't know what the timeline is. I will say that up front. It's a work in progress. It's a discussions, early stage thing. Conifer is working on bringing a CO2 pipeline into this fields. If they bring a CO2 pipeline here, it's not that hard to move it up here and all the way up here. If CNRL has any input into it, they want the CO2. They will get the CO2. One way or another, they will get the CO2. Once the pipeline is in, it will make its way into these fields. Is that going to take a year, 2, 3? I couldn't tell you. What I'm telling you is, we know the reservoir is there. We know the production capacity is there. We know the field processing facilities are there. We know the managements want it. And we now have a source that management is working on to bring the CO2 in. How does the oil field services limitations impact all this? In the near term, it's a big deal. In the long term, over 2 to 3 years, not really. We can find steel, we can find whatever we need over a 2 to 3 year time frame. Once the CO2 pipeline comes in, once it gets sourced out, once the engineers decide which wells to inject it down, they work on the development cycle. It's going to take time. So we'll have some time for this supply crunch to work itself out. And I will say this right now, I will put myself on the spot and tell you this. If you look at my portfolio 5 years from today, Razor will probably still be in there, because these sorts of projects take time, especially when you got 6 of them. It takes time to build this stuff out. Razor's a small company. They don't have the funding to go and, jack up spending into everything and work on all these fields all at once. They just don't. So it's going to take time. They're going to grow this thing out slowly. It's going to be a 3, 5, 7 year thing, slowly going in, reactivating. So the upside is there. Production can go up to what number? I'll leave that up to your imagination. I showed you what Weyburn did. I showed you what the history is of these fields, how much they used to produce. I'll leave that to your calculations. Could they find a partner and speed that up? Yeah, of course. They could find a partner. CNRL could be a good partner. Conifer is backed by a fund. Conifer is backed by a fund that is run by 9 Point. 9 Point, the same that runs the Eric Nuttall Fund. So they've got cash. What is or isn't going to happen, I can't tell you. But if I can play poker and I'm starting out every hand with pocket aces, yeah, I'm going to play poker all night long. So I got 7 hands here that are all pocket aces. How it plays out, I don't know, but I like my odds. Okay. So just a couple numbers I'll throw out there. The South Swan Hills unit is about 1 billion barrels original oil in place. The Swan Hills 1 is 2 billion oil in place. So that's about 3 billion oil in place. If we go back to Weyburn, the CO2 added 16% extra recovery, and the other vertical drilling added 10%. So 27% is what they added to the reservoir. Let's take 1/7 of that. Let's say this field is not going to work, blah, blah, blah. Let's take 1/7 of this 27% extra recovery. Okay, 1/7, so 4%. Take 4%, multiply it by your original oil in place, accounting for the fact that Razor only owns 50% of Swan Hills 1, you get roughly 75 million barrels of extra recoverable oil. Oil in the ground is valued at whatever you want. If you want to value it at $2 a barrel, that's $150 million. That's $7 a share. Most people will value oil in the ground at $10 to $20 a barrel. $750 million to $1.5 billion. That's about $40 to $80 a share. If the CO2/water flood is 1/7 as effective as Weyburn, I'll leave it there before people start calling me crazy. Could increased water injection increase production? Yes. Yep. If they got the water injection wells running, if they got the right source of water, yes. Again, that's 1/7 of Weyburn. If someone knows reservoir engineers here, if someone knows all the science behind it, you could probably get a better number than me. I'm just going to be conservative to the point where I literally cannot be any more conservative, and I'll leave it there. ARO is a big problem. They've got all these wells all over the place that they have to retire at some point. Asset retirement obligations is ARO. Some people are all worked up about this, rightfully so. Everyone has their own interpretation of ARO. So Razor's spending about $2 million a year on ARO, and the AER, the Alberta Energy Regulator, is happy with that. ARO is a big problem for wells that are suspended and you have to abandon them. At $100 plus oil, every single well in Razor's fields is economic to fix up and produce. Therefore, it's no longer an ARO liability. Is it a liability 10 years from today, 20, 30, 40 years from today? Yes. We know from Weyburn's field, from CO2 injection and water flooding, these wells, once you got CO2 in them, they'll produce for another 20, 30, 40, 60 years. So why are you panicking about asset retirement 60 years from today? It's not an issue in my books. You can take it as you will. The second thing, discount rates. People look at reserves and they say, we're going to put a 10% discount rate on it, and therefore any reserve like 10 years from today is worthless. We know that the CO2 flooding is like a long process. It's a 5, 10, 20, 50-year process. So if you want to put a 10% discount rate on it, go ahead. It's not going to give you the real clear understanding of what this is worth. If we look at Weyburn's field again, one more time, they did very little drilling here. I worked Cenovus Weyburn in 2015. I worked this exact field. We were not drilling anything. It was like status quo, oil prices are low after 2014. We're not going to spend any money. And look at the decline rate. In 5 years, it declined 20% without any new drilling. So you're telling me you're going to put a 10% discount rate on a reserve like that doesn't decline? Again, open to interpretation. I'm sharing my opinion. The EOR schemes and the water flooding schemes, in my opinion, should not get discounted at 10%. That's for the high decline shale wells and the high decline production conventional wells, because you got to pump a lot more money into it to get those reserves out of the ground. In the case of EOR, CO2, water flooding, I don't think a 10% discount rate makes any sense. So again, I'll leave that up to you. You can run your own calculations based on their current reserves and adding whatever number you want here with the CO2 flooding. I should also mention, this 75 million barrels I'm telling you is just for these two fields, South Swan Hills and Swan Hills 1. If we go back up here, they also own East Swan Hills, Virginia Hills 1, K-Bob 1, K-Bob 2. They got this field here. I'm not sure what this field, I think this is a gas field actually. And then they got potential strategic partnerships with Conifer. The 75 million barrels is just for Swan Hills, which they only own 50%, and the South Swan Hills, which they only own 90%. This they own 100%, this they own 100%, and the K-Bob units, both of them, they own 100%. I think I've made my case. So I'm going to leave it there. I'll open the floor to questions on the Zoom. If there's any chat questions or anyone wants to, I believe I still have the mics open. I can open the mic here. If somebody wants to raise their hand. If not, we'll move to Wescan and kind of go from there. But yeah, I am still doing a lot of work on due diligence on Razor. This is not the end of it. This is just the beginning. I needed this clarity to know the upside before I went in. I found a decent sized block, thankfully, that I was able to buy a couple months ago or 6 weeks ago. Okay, have you spoken to Razor management? Yes, I speak with Doug relatively often, whether by email or by phone. It's very early stage. It's very, very early stage. They're busy doing reactivations right now, getting the wells on to get some money, get the production flowing. The CO2 is more a little bit on the back burner right now, but I can tell you it's something that they think about every single day. When you're sitting on something like this and the macro outlook suddenly becomes very positive, I think some of you are thinking the same thing as to the upside here. Imagine owning the company. Imagine owning, Doug owns like 8% or something of the shares. Imagine sitting on that and trying to sleep at night. It's tough. Knowing what you've learned, what does Razor need to do to better tell the story? There's nothing really they need to do better. Their corporate presentation is really good. It highlights a lot of things. And I think they're just too early stage right now in the CO2 part of it. Give it 6 months. Let them get some discussions going with like Wolf Midstream, the Canadian government, the Albertan government. They might get funding to do all this. CCUS is hot right now. The CO2 flooding may not be as accepted, but CO2 sequestration and using it, blah, blah, blah. It's very hot right now. The Canadian government is in on it. So there's lots that can be done here. Has management made their strategy clear on prioritizing production? Yes, I believe so. Yeah, I think they're working on it. They're not in any hurry to pay back debt. They're actually taking on more debt, which I've said that's great. In a rising commodity price environment, the more debt you have, the more you can speed these things up, the better. So I'm fully on board with that, especially if it's with AIMCO and Arena. Perfect. Those two are the best lenders I think out there. One is AIMCO is very supportive. Arena is more predatory, but they also can't take the company bankrupt. So worst case, worst case, they get a 10% royalty. You know, it's not the best scenario, but we as common stock shareholders shouldn't be worried. Just my opinion. 52-week low of 22 cents. Now it's at $3. How much more runway is there? I'm not gonna answer that question because I'm gonna get thrown into the crazy jail if I give you a number that I have for it. Virginia Hills, the old Pinecrest that went bankrupt. I don't know the history on these fields. Sorry, but I will, as I continue my due diligence, I will look into the history, what happened, and maybe some more nailing down the exact upside and this pipeline issue and kind of what happened. I'm working on it. Has the company given any timelines for when CO2 will be operational? No. This is very early. I'm telling you this because I think I've identified something. You want to get in? No, I wanted to get in on the early stage before any of this happens, before any of this makes it into the public, that, you know, they got some CO2 upside and they're working on it, you know, et cetera, et cetera. I said, look, I'm just going to buy my shares. I'm going to park them. After that, whatever happens, happens over time. It seems that management is not too old. Yeah, correct. Yeah. They would do well to extend the production as long as possible. Yeah, that's why I really like this company. Like, management has not been sitting on this field for 20 years and they're bored of it. They just bought this in 2017, I believe, 2015 or 2017. So they bought this for a reason. They bought it at the lows. I think they only paid $20 million for this entire package because people were concerned about ARO and dead wells and all this other stuff, which doesn't mean anything right now, in my opinion. So yeah, thank you. What will be? No, I'm not going to say any target prices, please. I will let you pick your own number for additional oil in the ground, pick your own number on what it's worth, and assign a target price to it. Same with the production. Look at Weyburn. Look at what happened there. You can proxy that into what you think is going to happen in the Swan Hills units, in the KWAB units. So if production goes up 5x, you run the cash flow at 5 times the production. Keep in mind, I mentioned this at the start, they already have processing facilities to have 80,000 barrels a day, 60,000 barrels a day. So they're not spending any more on building anything, which means the net back on these additional barrels are just going to be enormous. So pick a production number, run a cash flow on it, bring that back to what the share price is worth. I don't want to throw numbers out there. Sorry. There are several if questions that need to be answered. Correct. Yep. There are several if questions. My due diligence was that, look, is the oil there? Yes. Are the reservoirs compatible with CO2 flooding? Yes. Is the processing capacity there? Yes. Are they working on a source of CO2 that they can get help with CNRL and Conifer? Yes. Do they have a bunch of old wells they can reactivate and get cash flow in the meantime? Yes. Do they have solid backers that are going to help them through the cycle? Yes. There's not really much else I can do. If they already had a CO2 flood going and production was 3x, the value would already be reflected in the share price. So it wouldn't be a good investment. Just the way that I look at it. Okay. Other names, I'm not sure about other names that have CO2 upside. I picked the one that I think has the best. I've showed you that other than the Leduc, Nisku, and Keg River, these are the best reservoirs out there. They have the highest producing wells. So why bother looking into other producers, in my opinion? I'd rather focus my due diligence on the one that has the check boxes that I talked about. At what oil price does the CO2 not make sense? Once it's running, you can run it at pretty low oil prices. It's not a big deal. It's about having the aggressiveness to start the process and get it going. And if you believe that oil prices are going to be $100 plus for the next 12 to 24 months, I think that's enough time for them to get everything set up. Who are potential acquirers? I would say Conifer and CNRL would probably be the biggest. CNRL, especially if a CO2 pipeline came in, I would be very worried about CNRL coming in and making an acquisition. Management owns 25% here, so they've got a lot of stock here. They've got a lot of compensation to keep the party going and actually run the company as is, rather than sell it. Do you know if Doug will be partnering with a bigger company? So it's very, very early stage. Again, like this is just an idea that I've thrown out here. I know Conifer is working on it, and that's where we are. Conifer's website mentions CCUS. They own the 2 fields. They've got money. CO2 is hot right now. There's a lot of money being spent on CO2 pipelines and sequestration and all this. That's where we are today. What will or will not happen, we need to give it time. I'm happy to sit back and wait and let it do its thing. Why rush it? What prevents other conventional producers from doing CO2 injection? So there's 2 things. Your reservoir has to be conducive to CO2 injection, and B, you need to have enough oil in the ground to make it worth it. A lot of conventional fields are just too small to be worth bringing CO2 in, building the facilities, building the injection wells, etc. You want big reef, I think they call them reef reservoirs with massive oil in the ground and low recovery factors. Well, Leduc's been tapped out, Niskay's been tapped out, Keg River's tapped out. The oil sands are using SAGD and mining. This is the best spot to be in. Kaybob, South Swan Hills, Judy Creek, Virginia Hills. These are like the big conventional, massive oil in place reservoirs. Are they going to start providing more guidance? I don't think we really need guidance. I think you just let the story play out. Why go micromanage? Trying to figure out what's happening on a quarter to quarter basis. If they have 300 barrels or 400 barrels, it's not really that important. I'd rather they focus their time on getting these projects up and running, including the geothermal. I haven't heard anything from management, no call on any new projects. Weyburn and Mydale. Cardinal owns Mydale, I believe. They're the only two I know in Canada that have this. Yeah. How do you expect management will spend excess cash? I think it's all going to go to reactivations, and getting these projects going forward. Quality of oil, it's light oil, very, very light oil. So it's great. Yeah, we don't need dividend buybacks right now. Every dollar they put back in the ground could potentially give them $10, $15, $20 over the next 5 years, 5-10 years. So I don't care about dividends and buybacks. It's not important in a company in this phase. Okay, so I did have somebody with their hand up here. So let me see. Okay, yeah, Philip, go ahead. Okay, we'll come back to you, Philip. Okay, how do you feel about the geothermal projects? They're pretty cookie cutter. There's nothing really new to them. The geothermal is a little bit different. Their reservoir water is coming up at 115 degrees Celsius. They're using the heat to generate electricity. So yeah, pretty cool stuff there. I think it's going to be operational. I see no issues with it. I've heard no issue of anything going on. I'm pretty confident in that, geothermal and the power gen. Yeah, I can't speak to the recession risk or anything like that. I'll leave that up to everyone's individual interest in that. So I do have a hard time limit here, so I'm gonna move on to Wescan here before I answer these questions. Okay, so I don't know anything about this, Rob, the Joffrey field, but Whitecap is another one that you should be, that I am watching closely for the potential upside here. The typical cost to put a pipeline in. So get this, what I think is going to happen is when they put the pipeline in, whoever is supplying the CO2 will make a deal that they will pay for the pipeline and everything as long as they sign a supply deal that Razor or Conifer is going to buy CO2 for the next 5 years or 10 years. So I don't even think they spend any money on the pipeline. The pipeline company will, and then make a long-term take or pay contract on it. Yeah, so I was told by another person that I keep saying you should do this and you should do that. So I'm stopping myself from saying that because none of this is advice. This is all my opinion and what I think is happening. This is what I should be doing and what I am doing. So thank you. Okay, so what's the potential assuming they can never get CO2? Again, I'm going to leave that up to you to calculate. I still think they can get double their production, maybe even triple it with just water flooding and reactivations, let alone the CO2. But I'll move on to Wescan here. I know there's a lot of people who came in just for Wescan. So the main info, 41 million shares outstanding, basic, after the recent raise, 44 fully diluted. 5 million of them are locked up until August, which is a private placement. The market cap fully diluted, about 14 million. The net debt is about 2 million. It's a working capital deficiency. It's not a debt instrument. So nothing is due, nothing has a payment date or anything like that. So about $15 million is what it's worth right now, enterprise value. Q4 revenue, about 350 grand. The adjusted funds flow was negative, so they actually lost money in Q4. Q2 plus Q3 plus Q4 revenue, $1.1 million. The adjusted funds flow was about $50,000 is all they made for the last 3 quarters. The ARO is roughly 1.7 million. So some people like to treat that as debt. So I'm going to throw that in there in your calculation. That's the basics. It's worth 15 million. Its revenue is roughly 1.5 million a year. So trading at 10 times revenue, trading at like 500 times cash flow or adjusted funds flow. So why am I in this? I'm going to do a full disclosure and say, when I did my due diligence, the share price was at 10 cents. That was a private placement that was offered to me. So everything I show here is, keep that in mind when you look at what I'm telling you here today. At 10 cents, the company's value was roughly $6 million. It's today 15. 56 BOEs a day, 94% oil. Management and directors hold 30%. Management's friends and family hold 30%. White Tundra, small funds, and then other retail people who have reached out to me or know about Wescan hold another 30% plus. So about 90% is basically here. I can tell you that this 90% that's here is not going to sell before the drill of the new well. Taking a stab at what I think is going to happen. And I'll explain the new well here and why it's so important. Okay, they have 5 wells that are being worked over. I believe that's as we speak, we're getting these workovers done. Once they're done, we'll be at 100 BOEs a day. There's another 2 wells that need some pipeline fixing. Once that's done, which will be later in the summer, we'll be at 125 BOEs a day. So you're basically doubling production in the next couple of weeks. So take these numbers and double the revenue in the next couple of weeks, or as we speak. Again, the fixed costs are the fixed costs. They don't change. So this entire 1.1 million of new revenue from these new wells, worked over wells, is going straight to adjusted funds flow. So what does that mean? That means that instead of making $50,000 a year, they're going to start making more than $1 million a year of adjusted funds flow as we speak. So as we speak, the adjusted funds flow is going up by 20 times. Do with that as you want to calculate it. But it's still not that interesting. A $15 million company making $1 million a year of adjusted funds flow, not that great. Okay. Before I go into the new drill, I'll talk about the royalty situation. Wescan owns a few sections of land that are owned by Prairie Sky Royalty, PSK, on the Toronto Stock Exchange. They pay 15% royalty flat on that, no matter how much they produce and no matter what the oil price is. On their other lands that are freehold or government lands, they pay 0% royalty until payout, and then a flat 5% royalty after that. So very, very good royalties structure in high oil pricing. Other companies are paying $40 a BOE or per barrel of oil for royalties. Wescan is paying $5, $7, depending on oil price. The history of this field. So a little bit of a history. This field was owned by Canrock, which was run by the same CEO of Wescan. They did about $2 million of 3D seismic study. They found some oil locations. Then Canrock sold to Alston in 2012. They never drilled this location that I'm going to talk about. And Alston went under in 2014 when the oil price crashed. The property went into receivership, and Greg, the CEO, picked it up in 2015, knowing what was under the ground and knowing that he would have to wait the cycle out until the prices were supportive. Okay. So the 3D seismic is $2 million of 3D seismic, which tells you exactly where the oil is. It gives you a good idea of where the oil is underground. Greg and his geologist were both with Canrock. They're now both with Wescan. They know where the oil is. Management, again, Greg Busby, he's done this 3 times already in the same area, starting up small companies, growing them in the Provost area to 300, 400, 500 barrels a day, and then selling them. Very familiar with these lands, very familiar with what's going on. There's another $500,000. That's the second part of the placement, the private placement, that is going to be given to Wescan by their largest shareholders, Leo Berzan. I think he owns about 18% of the company. It sounds like they're working on it right now. In my opinion, it's a 99.9% chance it gets done. So they'll have the $500,000 from the private placement of shares. They'll have $500,000 from the loan, and they're going to drill a new well that's going to cost $1.2 million, along with some cash that the company has. So that's the new drill. The new drill info, and I'll tell you why this new drill is so important. Is there any questions on the management or something like this here? Nothing. Okay. The 15 locations is not a correct number because that's vertical locations. But again, I'll talk about this here as we go. Wescan does not have a working website. I think they're working on it right now. CDAR is a place to be, and CDAR is where I learned everything, almost everything about this company, along with talking to people in the area. I used to work in Macklin, which is 15 kilometers east of Provost, so it's nice knowing the lands, kind of knowing the area a bit. So great. This is Wescan's lands in orange. They also own Section 21 here and Section 27, which are the ones owned by Prairie Sky Royalty. The government lands are these two, this kind of section here, this quarter section, and then these two. This 16 boxes is 1 mile by 1 mile. So just for anyone looking to understand how much land this is, every 16 boxes here is 1 mile by 1 mile. So 1 square mile, 640 acres is these 16 boxes. Each small box is 40 acres. That's how we check wells and find how much upside there is. These are all Wescan's wells. So the black dots are the vertical oil producers. The lines are the horizontal oil producers. These ones are the water injectors, the ones with the arrows on them. The well with the line through it is a suspended wells. So the ones that are going to be reactivated and worked over, as I talked about here in the last slide. And this is abandoned. This symbol means abandoned, this little cross thing. So very few wells. They don't have junk all over the place that they have to abandon and fix up. This is all he bought. When Greg saw Alston went into receivership, him and his geologist and Leo, the biggest shareholder, they got together and said, look, where is the oil? Based on the 3D seismic, where is the oil? Let's buy just the lands where the oil is. So that's what they did. They didn't even bother to pick up this stuff where there is no oil, this stuff, blah, blah, blah. They only bought certain sections out of the receivership that they know had oil. So that's a good sign that they knew what to target and they got it without picking up a whole bunch of other junk that they have to look after. These are the Wescan wells. That's it. They've got the 13 producing wells. They've got the 5 here that are the ones being worked over, and they've got two more, I believe, maybe 16 to 21 and 4 to 29, that are the ones with the pipeline issues. Here's your 56 BOEs a day being produced. Here's your water being produced. So about 450 barrels of water and 50 oil. So a total of 500 barrels right now being produced. And that's important because I'll talk about this in a bit. 500 barrels currently being produced. This is the cumulative production for each of these wells. So they've got some pretty nice vertical wells in here that made over 150,000 barrels a well, which is pretty good for a vertical drill. 15 to 21 right here is the horizontal well. So if we go back up a page, this 15 to 21 right here, it's been down for a while. So I look forward to this one coming back online because I think the production out of that is going to be pretty good. Horizontal wells always produce better for the most part than vertical wells. Thanks, Tom. So they paid $1.24 million for this asset. Okay, so this is just me verifying what management tells me or what the CDAR tells me. They tell me they made 56 barrels a day. Well, I'm going to check. I'm going to make sure that's what they're making. They tell me it's about a 90% water cut. Well, yeah, I verified that. The water cut is roughly 90%. The wells are good producing wells. They're not junk. There's actually oil here that's producing. Okay. On the 15 to 21, does Wescan pay royalties to both freehold and government? No, I believe it's only free. It's only Prairie Sky freehold because the majority of the well is here. This just happens to be the surface pad, I believe, because they have a vertical well already on the same pad. But again, I don't know how the royalty system fully works. All I know is the royalty here is really, really good. And they've negotiated this royalty. It's not the base case royalty for the area. They've negotiated this. Greg is an exceptional deal maker. So he went to Prairie Sky and made a deal, and I believe he went to the government and made some sort of deal. These are the pipelines. Same map, pipelines. What kills a lot of small companies with low production is having to truck oil from all their sites. They got to truck it all over the place. Trucking, each truck is roughly 175, 200 bucks an hour is what you pay them. So the cost does add up very fast. On a well making only 200, 2 or 3 barrels a day, it adds up very fast. So the fact that they have pipelines is way better. Everything is piped to their central facility, 429. That means their operating cost is very low, relatively, which is something to watch for. And these small companies watch for little things that can absolutely derail their profits. And they already have pipelines built, going where they need to go. So yeah, perfect place to be. Okay. So what are they drilling? What they're targeting is called a REX pool. The REX A pool or the REX member pool is what they call it. The REX pool is not like your other pools where they're like the Swan Hills pools I showed you, which are like kind of like a lake in a way. They're not like this. REX pools are like rivers. So you can see on the drilling activity with the REX, this is a bunch of West Lake, which is another private producer. You can see how they're drilling in a lake, in a river formation. Here's some of Surge's stuff and Repsol. You can see how they're drilling in a lake or in a river pattern as opposed to like a pool of wells. These ones as well are in a river pattern. And this is in orange, you can see Wescan's land here. You can see how the river goes right through the land. These highlights are mine. They're not, I don't have access to the seismic data. I don't know where the river is. I'm just guessing based on what I see here, that the river seems to go right through Wescan's land. And when I said earlier that they picked out these sections specifically to buy, because they had access to the 3D seismic, you can see what they were looking for and why they were buying it. So yeah, so keep that in mind. This is not easy stuff to find. This is not like a big pool where you just drill wherever and you get oil. You have to specifically find these channels and see how far they extend out. This channel obviously has ended here, it seems like, and over here, it doesn't continue on. So it's pretty tough drilling, but if you have seismic, if you have data from the area, you can de-risk your Rex drilling. And I'll share here why the Rex drilling is so important, why we're in that zone. Is there any questions on these maps so far, or how I'm looking at them? Anything like that? No, okay. Perfect. So this is the production of their 4F29 battery, the main processing facility. Again, I'm going to verify everything that management tells me. I'm not going to take it for granted. I'm not going to take their CDR filings for granted. I'm going to go and check everything. So here we see the oil production, about 50 barrels a day, as they told me, as the CDR filings show. We look at the water production, about 400 barrels a day, again, as the filings show. So everything pans out. Table, check the same thing on table. We got oil adding up to what they tell me. We got the water is in a different thing. Sand is a big problem in these heavy oil plays. So we see that the sand production is not too high, which is good, because the more sand you produce, the more of an issue that it becomes in terms of keeping wells running, keeping your facilities running. So their sand content being relatively low is good. We also see the gas here has randomly jumped all of a sudden. So they had a problem at their facility where they weren't able to sell the gas properly. It's now back online as of October. And at today's gas pricing, it's making roughly $25,000 to $30,000 a month in gas production. An additional upside that is not reflected in their Q2, Q3, Q4 results. $20,000 a month, $25,000 a month is another $300,000 a year. It all adds up. These small companies, it all adds up. And anyone looking at just the documents would not have picked this out. Or maybe they did based on the gas production, but it doesn't matter because the point is that the gas production is online. It's making $25,000 to $30,000 a month bonus. The facility's history, it used to make 100 barrels a day. It used to make way more gas. What does that tell me? That tells me that once these workovers are done, this is what we're going to look like. It shows that the wells actually produce this. I'm again verifying everything that they're telling me. I'm not taking anything as gospel. You verify everything. The facility's operating history. They've had some spills. Nothing too crazy though. 2002, 2009, 2014, pre-Wescan, they had some sort of equipment failure, corrosion. But nothing crazy, you know, nothing blew up or nothing had a huge spill, which is great. You want to be with operators that have a good operating history, because one spill can destroy this company. A spill that goes into a water body, the company's bankrupt that day. So you want to be in companies that have a good operating history. I'm using Petra Ninja for this. So everything, a lot of the stuff that I'm showing here is with Petra Ninja Premium. The free version has a lot of details as well, but it doesn't have everything. So just keep that in mind. This is the facility that they own. Inlet separator, looks like a line heater of sorts, water and oil tanks. There's an abandoned injector well here, equipment and stuff. This looks like a flare stack. a little bit clearer. One of these is probably a recycle pump. A little compressor building probably for the gas. So what is it worth? They tell me it's worth $5 million. Yeah, I would agree. Inlet separator buildings probably $1 million plus. The line heater is $1 million plus. The flare stacks 250, 500. This looks like another sort of separator building here, or maybe this is the line heater. That's another $1 million. The water tanks 250K. Probably a bunch of equipment sitting here, another 250. Recycle pumps, another 250. So yeah, it's worth roughly 5 million. We want to verify this because they say it's worth 5 million. Well, who knows what it's really worth? Well, I'm telling you, based on my experience, it's worth roughly somewhere between 4 to 6 million. They might have some other stuff here that I don't know about, which could be worth more. But I'll give them the benefit of the doubt here. It's between 4 to 6 million once you add up the tanks and all this other stuff. Gas, again, you can see how the gas rate has suddenly increased the sales in the last Q4, extra 25 grand a month. Water, verify the water again, make sure it's what they tell you. So between the water and the oil, we're producing roughly 500 barrels a day right now, 450, 500. After the workovers, it might go to 1,000, 750 to 1,000. The facility is good for 2,500 barrels a day. I haven't verified that, but I'm gonna go and pull up the PIDs and the plot plans of this this facility and make sure it can handle 2,500 barrels a day. But right now, there's about 1,500 barrels of extra room just sitting there. Just like I talked about with Razor, you want to be in companies, and I want to be in companies where they already have processing capacity, so that I'm not spending money on pipelines and compressors and equipment that's not going directly into the well. So this is perfect. The facility is about 20% full right now. It'll be about 40% full once the workovers are done. So I have lots of room there for additional production. Okay. These, I talked about the Rex rivers and the map I showed you. This is more zoomed in to the Rex wells. This is all Westlake stuff. You can see how the river just, it's like a river. It doesn't flow in a straight pattern. It can go wherever it wants and move randomly and not be straight in a straight line. This is a bunch of Surge wells, Surge Energy. This is Wescan, obviously. This is another Surge multi-leg horizontal, tracking very closely because as everyone knows, I'm a big investor in Surge. These are Dark Warrior wells. That's another private company. Keeping an eye out on these as well. I'll share more about every single one of these wells as we go here. The ones that matter anyway. How deep are the wells? Of roughly 700 meters, 700 to 800 meters, somewhere in there. So cheap to drill, 1.2 million. Wescan is going to drill a multilateral well, just like this and this and this and these two here. I've spoken very highly about this multilateral technology with Surge Energy's Sparky stuff in the past. Wescan is going to drill a 9-leg horizontal. And I'll talk about that here as I go. But just keep that in mind. It's not a horizontal well we're drilling. We're drilling one of these state-of-the-art multi-leg horizontals, which are, as people know, again, I'm very bullish on Surge and their Sparky because of this technology. So the also reason why I'm bullish on Wescan. So let's talk about Westlake's new drills. So if you go back up right here, they're about, you know, if this box is 1 mile by 1 mile, they're about 3 miles away, so 5 kilometers. Westlake's new drills, they've got 2 multi-leg horizontals and they've got a test well that they drilled. Here is their new well, 12 of 25, right here, this one. Drilled in 2018, came on in 2019. or no, sorry, drilled in 2019, came on late 2019 at 650 barrels a day. Wescan only produces 100 barrels a day today after the workovers are done. If our new well, if Wescan's new well produces 650 barrels a day, I think you can see the upside that I'm seeing here. Why I'm invested in this company. The upside on one well is great, but this one well is a company maker, in my opinion. You will increase production from 100 barrels a day currently to, pick your number, right? Pick your number. I'm showing you one well 5 kilometers away that made 650 barrels a day. The second well, the 2-24 well, this one right here, came on at more than 700 barrels a day. 2.5 years later, it's still producing 100 barrels a day. It only cost $1.2 million to drill, complete, and tie in these wells. Some of the Montney wells come on at 700 barrels a day, but they decline way faster and they cost $7 million. This is a potential 700 barrel a day drill. Potential, very potential. For $1.2 million with a very low decline rate on a company that basically produces nothing right now. So it's the inflection point. It's this one well that's going to make or break this company. So let's look at the logging a little bit more. We want to know, is the oil really there in our lands? So I'm going to go back to this well here, this 15-21. It's a horizontal, drilled in 2014, I believe. It's a Rex well also. Okay. So this is the geologist's notes. The entire way through the horizontal, it says oil staining, fast streaming yellowish cut. Patchy oil staining, fast streaming yellowish cut. Patchy oil staining, fast streaming yellowish cut. They know there's oil here. Right here, 15-21, we know the Rex River flows through here. We verified it. This entire horizontal is through the Rex River. So we know the river comes up this way and possibly goes right here. So just give me a sec. Sorry about that. So we know that the Rex River goes through this entire horizontal. We already know that because we have the log. And the entire log, this is again available on Petro Ninja, same thing. You can read it yourself. It says oil staining the whole way through. Okay, so we know these wells are great in the Rex. We know we have a Rex zone here going right through our land. I keep saying R, but I'm talking about Wescan land. Okay, so we verified those two things. Now, 13-26, that's the Dark Warrior well, right here. Look at the way the well is set up. This was just drilled in November of last year. They don't own any rights in Section 27, Wescan does, but look at what they're trying to do. They're trying to get into the Rex channel here. This is also Rex well, same with this one. They're trying to get into Wescan's Rex channel. So what do I think? I think the Rex, because these are all Rex wells, I think the channel goes this way. It goes through the horizontal, goes through the 28 lands, and then takes a sharp right and goes somewhat like this. So if you can follow my cursor here, that's how I think the Rex channel is here. So it goes through Wescan Section 22, the 21, the 28, and the 27. And then Dark Warrior has tried to get close with their new drill, and then it goes into their old drill here. This is very important because what I'm telling you here is a guess based on what I think, but it's backed up by the company buying these properties and backed up by the $2 million of seismic, of 3D seismic, that they've chosen to buy these properties. So I don't have access to the seismic. I'm not going to pay $2 million to get access to it. But I can make a pretty damn good guess as to the way it's going based on the wells I have already here. Okay, so we have that agreed upon. 5 to 35, this is the other Dark Warrior well up here, this one here. Not a bad well. It came on at about 150 barrels a day, 175. Again, low decline. It's been running for about 4 years. So the decline rates in this area is about 25% a year, 25, 30% a year, Cliff. Yeah, so low decline. Again, the Dark Warrior well came on 175. So I'm going to take that as my low end estimate of what this well can produce. Why is there an interruption in square 15? No one has done the work on it. Now, keep in mind, the Rex channel is a river. What rivers do is they get narrower and they get wider. So you can see how the channel here widens, and then it's kind of this narrow band all the way through. I think the channel here is narrow, and then it really becomes too small to be worth drilling in 15. And then here is when it widens up again. Greg himself has told me that the channel they have here is the widest seismic showing in the whole area. So make of that what you will. If this is a wide channel and Wescan's is even wider, can they put 2 wells side to side? Can they drill a 14-leg multilateral potentially and like really extend it out? Maybe. Again, a lot of data I don't know. I can't verify and I can't confirm. I can only do the due diligence to give myself the best odds and the best risk reward scenario. So if you tell me, well, how do you know the channel is wide? How do you know the channel even exists? I don't, but I like my odds. And given that this company just drilled a well 3 months ago, look at what they're trying to do. They're trying to get into Wescan's land. Look at what this well is trying to do. They're trying to get into Wescan's land. So it's a positive anecdotal signs of what's going on. The seismic is from 2012, I believe, Gordon. But it is 3D seismic. Westlake has access to the seismic, and so does Dark Warrior. Look at what they're trying to do, target the Rex channel in this area. Westlake has so much land all over the place. Why are they trying to get close to here? They are going to exploit their best properties. When the oil prices are higher, they're going to try and exploit the best properties. That's what Dark Warrior is trying to do. That's what Surge is trying to do. So this Surge well is interesting because I think the channel might go this way and then come down, or it might be a totally different channel that they found and are trying to hit here. I don't know. This well is too new for me to have data on it. Okay, the well logs. So Cliff, to answer your question, very little oil flows across sections like that, especially with the heavy oil. Unless you're in the zone, you're not gonna pull oil from other sections unless you're drilled right into it. So no worries about Dark Warrior stealing Wescan's oil. So let's look at more logs here. We're looking for the Rex zone. This is 9 to 21 well. Looks to be about a 25-meter zone. So from 777 to 802, 803. It's about a 26-meter Rex zone. And I'll tell you why this is important here as we go, but just keep the number in mind. It's a 26-meter zone. 9 to 21, we go back to the map, is right here. Hang on. Right here, 9 to 21. It's an abandoned injector, so it doesn't show up on the map. So we know the 15 to 21 is in the Rex zone, and now we know there's a second well that's in the Rex zone with a 26-meter thick pay. Okay. Right on. So we know that. Now, just again to go over the map, 15 to 21, 9 to 21. This is 12 to 22 well. There's no Rex zone here. So where is 12 to 22? Right here. So isn't that interesting? There's a Rex zone here, but and there's a rec zone mostly through this horizontal, but there's no rec zone here in 12 of 22. So that's how important this seismic work is, and the logging and the due diligence. If they screw up on the well by, again, this is 1 mile by 1 mile. So this is a quarter mile. This is about 400 meters across. The abandoned injector with the rec zone right here is less than 200 meters away from the well with no rec zone. It's that important to get your placement correct. They have 3D seismic. They have results from this well. They have results from 9 of 21. They have results from this. So is there a risk that we miss the zone? Yeah, there's always risk in everything. But the fact that this 15 to 21 hit oil, and the fact that they have more now 3D seismic to work with, I think the odds are pretty good that they hit the zone. But again, I'm placing a bet based on what I know. Rec zone meaning, okay. Okay, I should explain this better. So when you go underground, the layers of rock in the ground are like a tiramisu, like a cake. They have different layers. Some have oil, some have gas, some are just rock, some are clays, some are limestones, etc. The rec zone is a certain zone, like a certain layer of the cake, if you will, in that area that Wescan is targeting. So if we go back up here, we have a rec zone, we have a Lloyd zone that's also oil producing. We have a comic zone that's also oil producing. We have a Dyna zone that also has oil. I think this one's a water zone maybe. And then there's other zones that have nothing. It's just straight rock. So that's what we mean by the rec zone, the layer of the cake that we're targeting. So now 8 of 24. What's 8 of 24? 8 of 24 is this well right here. Westlake used this as a test well to find out how thick their zone was, the Rex, and they drilled these two monster wells based on 8 of 24. Okay, 8 of 24 has a 20-meter zone from 777 to 797, about 20-meter zone. The zone next to Wescan's wells is 26 meters. It's 30% thicker than Westlake's monster well, the ones that produce 650 and 700 barrels a day. I'll leave that open to your interpretation and your imagination. You want to add 30% straight to what they're producing? You want to use a different method? You want to use a different methodology? I'll leave it up to you. Management is saying the well is going to produce at 200 barrels a day. I think we have a chance here of hitting a absolutely crazy well. Is it going to happen? I don't know, but I like my odds. If Westlake can drill a 650 barrel a day well in a 20-meter zone, we have better seismic, we have a wider channel, we have a thicker zone. Yeah. This is the same Westlake well I talked about, the monster well. In 2.5 years, it's produced 300,000 barrels of oil. Okay. Let's say for the next 2.5 years, oil averages $100 a barrel, roughly. So let's take the revenue, just the revenue, strictly revenue, in the next 2.5 years. So till the end of 2024, one well costing $1.2 million can produce over 30 million of revenue. 314,000 barrels times $100 a barrel, very low operating cost, almost no royalty. Very nice gas or water oil ratio. You know, we're not producing a whole ton of water that we got to process. 1 barrel of water for every 3 of oil. We're producing some extra gas that gives us more money. At $7 AECO, at $5 AECO still makes money, at $3 AECO still makes money. Their gas operating cost is $1.35. Anything over that is profit. So you're banking on one well, and I like my odds. I really like my odds here of 200 barrels a day, 400, 600, pick your number, run the math on it, on revenue, run the math on cash flow. I'll share a table here as to what I think. A lot of people are familiar with the Clearwater, Martin Hills. They've been doing this multi-leg thing forever. I mean, they've had time, a year or 2, 3 years to get the science right, to get the technology right. This is not a new technology that Wescan is using. They're pretty familiar with this. And the best part is they're using Westlake's rig. Westlake, the rig that drilled this exact well, Wescan is going to use the exact same rig, the exact same crew, the exact same drilling services companies, the exact same engineering firm. De-risked. It's a de-risked property, in my opinion. You're not taking on much risk. It's using the same crew, the same crew that's drilled 85 of these multilaterals with not a single failed well. All of them have hit oil. And I think the lowest one was 150 barrels a day. There's no obstacles. They have the rig, they have the labor, everything is set. They're going to drill in mid-May, roughly, is the plan. The surface lease is, I believe, ready to go. They have access to casing, as far as I know. So, yeah. As far as how many wells they have, I'll leave this up to you. Westlake drilled 2 wells in this much area. So they have this land, they have section 21, and they have almost all of section 27. I would use 4 wells as a minimum, maybe 6 if you can jam them in. But it gets better. The 4 to 6 wells is straight wells. However, hang on, I'll go to this. What Spur is doing, Spur Petroleum is the most successful company in the Clearwater. They're layering 3 wells in the same zone. Because the zone is so thick, they're drilling 3 multilaterals in the exact same zone on top of each other. Spur's zone in the Clearwater is 20 meters thick. And they jammed 3 wells into it, 3 successful wells. Wescan's Rex is 26 meters thick. So the 4 or 6 wells, if we can drill multiple wells into the same formation, could become 12 to 18 wells. Is it going to happen? I don't know. We will wait and we will find out. I think we should be able to do at least 2 wells on top of each other, and that's exactly what they're doing. They're drilling what's called a wine rack method. So think about the wine rack in your house or in the restaurants, how they have wines that are crisscrossing each other. That's how the Wescan well is going to be. It's going to be 5 legs on top of 4 legs. So why is that important? Because look at how much land Westlake's eight legs used up. They used up a lot of surface here. We're only drilling 5 because the other 4 are underneath the other 5. So can we jam more than 6 wells into this area? Can we jam 8, 10, maybe? If they're only taking up less space and they're on top of each other as opposed to parallel to each other. And I know I'm getting very technical here, but this is just stuff that I see and people aren't paying attention to, in my opinion. They're misinterpreting what's going on here. Do the stacked wells decline faster? No, they decline at the same rate. And the reason being that the Clearwater and the Rex are estimated to have really good horizontal permeability. What does that mean? That means that oil can flow horizontally very easily, but vertically it doesn't flow very well. So that in your 26-meter zone, the oil at the lowest point of the zone doesn't flow very easily to the top of the zone. So if you drill multiple wells, it's actually like drilling a brand new well. You're having no effect on the existing well. They're independent of each other. The oil is so heavy that it can't even flow like 5 meters up horizontally. It just sits there. Even if there's a well on top of it, you need to drill right into it to get the oil. Some people think that's a negative. I would say that's a positive, because if our zone was only 10 meters thick, A, it's harder to drill and find it, and B, you can only have 1 well. Whereas if it's 26 meters, we could have up to 4 if Spur jammed 3 multi-leg horizontals into 20 meters, we should be able to get 4 into 26. Is Wescan going to push the envelope? Maybe not. Maybe we just do 2. Great. Nothing wrong with that. Does the oil flow easier at higher levels? No, it doesn't flow easier. Like the higher levels is just like, instead of being 770 meters deep, it's 775 meters deep. It's just a layer. And they flow independently. I want to talk about this Devon Wolf Lake wells, because look at how far multilateral technology has gone. They're drilling like 14, 18 wells in like a fishbone pattern. Like this is, Penn West has drilled 47 legs off 1 well. Like this is not new stuff. This is stuff they understand. The drilling risk, in my opinion, is 0, especially if they're using the same crew and the same rig that Westlake uses. I think the risk is very minimal. This is not something we're using brand new technology that came out a month ago and we might miss the zone or anything like that. I don't think that's a possibility. Is there always a chance? Yeah, but you de-risk things as much as possible, and I take skewed risk reward bets. That's how I think I can make money, is by taking skewed bets that work in my favor, and you take enough of them and you will end up ahead. The other thing I want to mention is, yeah, maybe I'll leave that for now. Is there a 50-50 joint venture well with Westlake? Possibly. I don't have any confirmation on that or what's going on. But I know Westlake is interested in this acreage because obviously they've seen the 3D seismic. They know there's a Rex channel there, and probably a very, very nice Rex channel, maybe the best one they've ever seen. Wescan has been sitting on this since 2015, maybe since 2012, if you want to take the Canrock days into account. And now we have multilateral technology. So yeah, the timing is great. The reservoir is great. The geology is great. How did they get the drill pipe to curve like that? Yeah, I honestly don't know. It's like, this is really, really amazing what they've done here. 47 legs on 1 well. The well didn't actually produce that much oil, but just the fact that they did it. Maybe that's why Penn West went bankrupt, because they're not bankrupt, but they had to sell a bunch of acreage because they started doing these science experiments all over the place. So you do not draw down from higher levels and draw down at each lower level. Yeah, it's really hard to explain like permeability, but basically you have a 30-meter thick zone and the oil cannot flow up and down. It only flows horizontally. So if you drill in the bottom 5 meters of the reservoir, you're going to get oil from that area and maybe a couple meters above and a couple meters below. The rest of the oil just cannot flow. There's no space in the rock for it to flow. It's so heavy. So now you have to drill another well like 5 meters above that or 10 meters above that, which is why the wind rack drilling is great, because you have 5 on top and 4 on the bottom. So you're accessing more of the reservoir, doing it that way. Okay, great. What is this? So, okay. This is the Surge 11 to 10 well. It's about 15 kilometers north. It's in the Rex zone, I believe, or maybe it's not. But this is one of the risks that can happen. Because there's so many oil zones in this area with a stacked pay, what Surge has done here accidentally, they've drilled too far in the lower part of the zone, and there's some gas now that's started to come into the well from the zone below it. So let me explain that using this log. So they've tried to access the Rex or the Lloyd or whatever, but they've drilled too far in the lower part of the zone, and there's a bunch of gas escaping from the Cummings or the Dyna and going into the well. So the well produces very little oil so far, and it's just producing a ton of gas. So unfortunately, now they got to wait for this gas to bleed off. They might have to do some downhole work to block off the gas zone. But this is one of the risks that can happen. And which is why I like the wine rack drilling, because you don't have to drill way at the bottom of your zone. You can drill kind of in the middle of the zone, and then the four legs are more towards the bottom or more towards the top. So yeah, but I just want to mention this as a risk that I've seen this happen on 2 wells now in the area while I was playing around with Petro Ninja. Yeah, Robert has a great point here on the horizontal fishbone laterals, so please read that for more understanding. So valuation, everyone wants valuations. They want to know, okay, what's it worth? What's it worth, right? That's the main thing. So if the new well comes on at 100 barrels a day, we get a total of 200. I put a 25 to 30% decline rate on the new well and just put a 12-month average production, forward-looking production with only one drill at 100 barrels a day. I think I've made the point that I think it's going to come on at way more than 100 barrels a day, but this table is for you to pick whatever you think is going to come out of this well. So that's a 12-month average production at $100 oil. That's the revenue. That's the adjusted funds flow. Okay. I obviously think we're going to hit at least 500 barrels a day, given Westlake's well, given they have a lower zone or lower thickness. And that's the other thing. Like if you look at Westlake's wells, they're drilling into a river that's been already pretty heavily exploited in a way. Look at this, it's basically brand new here. So you can get a lot of oil out of new land as opposed to drilled up land, possibly. So anyway, I'll just say that I'm expecting at least a 500 barrel a day well, maybe more. Anything extra is a bonus to me. So 500, well, let's go here. 300 plus the 100 barrels a day they're currently producing after the workovers, 400. The 12-month average is 325. We're adjusted funds flowing 7.5 a year. Because we're not spending any capital, this is basically free cash flow. So if we hit a 300 barrel a day well, we're free cash flowing about 50% of the enterprise value. That's fact. If we hit a well like Westlake did, a 600 barrel a day well, your free cash flow over the next year with a very low decline is your entire enterprise value off just one well. If late summer they drill another one, and then they use a cash flow from that to drill another one in November, if they got 4 locations, let's say, then they drill another one in January, they got 4 wells going. What could the production be? I'll leave that to your imagination. They're only $1 million to drill. So if you hit a banging well, you can basically drill 2 or 3 more like in a couple of months straight out of cash flow. You don't even need to dilute or raise any more funding. Oh, sorry, this is at $85 oil. 100 WTI minus, I took a $15 differential for Wescan's oil. So these numbers are at $85 US WTI. Not WTI, but the price that Wescan's getting. How long can the revenues last? So, I mean, here's the Westlake well. 2.5 years later, it's still producing 100 barrels a day. 100 barrels a day at $100 oil gives you roughly $4 million a year in revenue. 2.5 years down the road for something that cost 1.2 today. Nothing wrong with that. I don't mind making 3 times my money putting in today in revenue 3 years down the road, and meanwhile making whatever I made in the meantime in the 2.5 years. So yeah, I will leave it at that. I am doing a lot of due diligence in this company still. I'm basically looking into every log, every well, talking to every reservoir engineer, every geologist, every person who's worked in Provost, like what's going on? Are we going to hit a decent well? Anyone who's drilled multilaterals for Penn West, for Spur, for Delta Stream, for whoever else, I'm trying to get a hold of them and figure out what to do here. Should we be using oil-based muds, water-based muds? Should we be using, like, how do we put this on water flood? What's the way? Like, there's a lot of stuff going into this, but For now, this is what I have. There's other stuff that I do due diligence on, but I can't really share it, or people don't want to be coded, or it's just like stuff that's not material enough to really share, I guess, in a way. So yeah. If the economics are so good, why isn't Big Oil snapping up these names? Because Big Oil, Surge, Crescent Point, Vermilion, Baytex, Whitecap, everyone in the area, Westlake even, they want companies, they want to do due diligence on companies that are making 1,000 or 2,000 or 3,000 barrels a day. They don't want to be doing due diligence on companies making 50 barrels a day, 100 barrels a day. So it's basically escaped their radar, A, and B, Greg is not selling. That's just it. Him and the directors own 30%. His friends and family own another 30%. And the small funds and whatnot, they own another 30%. How are you going to buy this out? You might as well wait for the drilling and see what it comes out at. If you're going to be paying way more than the market price anyway, you might as well just wait and let Wescan do the drilling and then buy them out once it's done. So that's why Big Oil isn't really in this. That's my opinion anyways, as to why. Yeah, hopefully that answers the question. I think I would say that this company probably got an offer from Surge and maybe Dark Warrior and Westlake already. Anyone who has access to the 3D seismic, when this company was trading at 4 cents or 6 cents, I would think that these companies tried to sneakily pull this out of Greg's hands, but he's been sitting on this since 2015, and he knew that when the time comes, they've got the well, they've got the acreage, they've got the land. In the meantime, multilateral technology has come very well advanced, as we know what's happened in the Clearwater, as we know what Surge is doing in the Sparky, some of the other multilateral wells out there. So that was a bonus to Greg's plans. He was just going to drill 6 horizontal wells. Well, now we can drill the same 6, get access to the same type of surface area downhole for the same price as one well with this multilateral technology. Seems like this is about the well results and you're confident on those well results. Yeah, I am very confident, and that's why I invested. And again, remember, I invested at 10 cents when this company was worth $6 million. So my downside was very low, given that the company is already projected to produce 100 barrels as we speak, or in the next couple of weeks. So 100 barrels a day of low royalty, low decline oil, put $60,000 a flowing barrel estimate on that. That's 6 million. That's what it was worth. So I got absolutely free upside on this new drill. I can't complain about that, really. So Robert has a great point here that when you buy a lot of stuff in this area, you have to swallow a lot of asset retirement obligations, because there's all kinds of stuff sitting out there abandoned and suspended, which is why I really like this property, because Greg and the team, they bought exactly the wells they wanted and exactly the sections they wanted and nothing else. So they'll have almost all their wells producing. The facility is going to be running. There's no suspended or abandoned stuff sitting that's uneconomic. So the ARO is low, right? It's only $1.7 million, and that's a long ways down the road. It's not right now. So yeah, if there's any other questions, feel free to put them in the chat. I'll leave that there. This presentation, I can't share it, unfortunately, the exact slides, but you're welcome to look at the recording and screenshot whatever you want. And then the recording of the whole presentation here will be posted by the evening here. So feel free to have a look at that. Any other questions here that I can answer? If not, feel free to reach out to me. Yeah, and then as you know, I like to use 8 multiples on my free cash flow. With a company like this, I'd maybe use 6 or 4. And this is just off one well. Again, this is just one well. So keep that in mind. I haven't even taken into account the additional drilling if this well hits, and depending on what it hits. Secondly, when they drill the multilateral, they have 9 legs that they can go around and try to find the zone, right? Right now they're only working off 1 or 2 well logs as to where the wreck zone is. Once they drill the multilateral, they'll have like 9,000 meters. Depending on how long the legs are, they'll have 9 or 10,000 meters of well logs, and tell you, are they in the wreck zone? Are they outside the wreck zone? That further de-risks the further development. Hitting the gas stream, that's just something I point out because I've seen it happen in the last couple of years, but very few wells are hitting this coal. I think it's some sort of coal bed gas stream or something, but it usually happens if you drill too close to the top or the bottom of your zone. Given how thick this zone is, 26 meters, I don't really see it as a problem, but I just want to highlight it because people ask, well, you keep saying the positives and you haven't talked about the negatives. Well, I'm telling you what the negative is. I'm just telling you it's a very low risk, low probability event, in my opinion. Do you think Craig and team have time limited perspective? Yeah. Like honestly, I think once the first well is drilled, I think this becomes a takeover target right away. If we get 2 or 3 wells drilled, I think it's going to get taken over either way by Westlake or maybe even Dark Warrior could come in and make a run at it. But I think it's better for those companies to take a run at it after the first well is drilled, because the production will still be relatively lower if the well is successful. So yeah, so there's that. I'd rather they don't go to a dividend model and they just sell everything once they get to a couple good drills or 1 good drill. What happens, I don't know. However, Greg is a landman. His geologist is very, very smart. There's a possibility that they use some of this money to go back and buy these little sections where they know there's oil from their 10 to 14 days. Greg's done this 3 times. He's found nice little pockets of oil, built them out and sold them. So I'm sure he's got another couple up in his brain there sitting somewhere. And I'm sure his geologist has a couple ideas that he screenshotted back in 2007 or 2010. You could buy land for cheap right now. No one is really looking for these opportunities. The big boys don't care. Like I said, they're still in the Montney and the big Duvernays and all this. So there's a potential this grows in 3 to 5 years, this grows to a 10,000 barrel a day company, 10, 15, 20,000 barrel a day company. Greg is still pretty young. He's not old by any means. He's got a lot of passion. He's got a lot of energy. So yeah, lots of possibilities. Would you know if a US investor has access to Wescan? Sorry, Jerry, I honestly don't know the answer to that. It doesn't trade over the counter, I believe, but there is an over the counter listing that any broker, as far as I understand, any broker can restart that listing. So if you're with a broker that is willing to do it, it might be worth to give them a call and say, look, why don't we restart this listing potentially? I don't know what the fees are, or if the company pays it, if the broker pays it. I honestly don't know. Is the financing in place to do the drilling? Yes. Yep. So the $1 million financing was closed. The debt deal is a status quo, in my opinion. I mean, it's with Leo, the largest shareholder. Why would he screw over his own debt? And I'll be honest with you, if the funding doesn't close for any reason, I think I myself am willing to go at it with my partners. I think it's going to close anyway, but for anyone worried, yeah, I wouldn't really be worried about something like this. What do you think the offering per share will be on a takeover? I have no idea. I honestly don't know, John. It depends on when it is. Is it after drilling the first well? Is it after 3 or 4? Does the well come on at 300 barrels a day? Does it come on at 700? Does it come on at even higher. I don't know how much reserves can they get for these drills, right? There's a lot of factors, but when I first ran my calculations at the 10-cent placement, I was looking for 10x within a year. So that's with drilling 1 or 2 or 3. I think it was 3 wells I had in my model, and there were 3 very conservative wells. After I did more due diligence, my confidence on the well being a higher production well is even better. Now, there's always a risk, right? There's always a risk with any drilling. Nothing is guaranteed, but I like my odds. I like the due diligence. I like the reservoir, the geology, the team, the fact that we're using the same rig, et cetera, et cetera. Will I lose my hair in the next 10 years? I don't know what you're getting at, but yeah, I'm not sure. It all depends on what you think of the macro and what you think of this due diligence and your own due diligence, your own understanding of the reservoirs and kind of what we're going to produce here. If they don't hit a well, if the well comes out dry for whatever reason, they're still producing 100 barrels a day. Is that worth 15 million enterprise value? Probably not, but it's not like the company's going to go bankrupt either. And maybe we'll drill another one. Asking you to tell the future, yeah. I wish I could tell the future. I do the best I can. That gives me the best odds and puts me on the right path. After that, could there be a random sinkhole in the middle of the path that I fall into? Yeah, but I mean, stuff like that you can't do anything about. So I'm going to pick the right path, places where I can make money, put the effort into the due diligence, talk to management, go from there. That's all I can do. So yeah, questions on your other stocks. I could take a few more questions on some other stocks, but I want to have a hard close here at 2:45 Mountain Time. But yeah, feel free. Do you see them taking on debt? No, there's going to be no debt, and there's going to be no more financings. I've spoken to Greg extensively on this, that we don't want to be taking on debt. We want to fund the second well out of cash flow if possible, and no more financings. We don't want to do more financings and dilute the company. I'd rather them drill 1 well now and wait 3 months, get cash flow, and then drill the second one, rather than try and scrounge together funding to do 2 in a row or something like that. And I've made that pretty clear. And I think the 30% of investors that are the retail plus small funds plus White Tundra that I discussed, I think we're all on the same page with that. So yeah, this management team is very flexible, and they work with us, with the shareholders, which is great. You know, I just got a call from Greg this morning, and it's a Easter Saturday weekend, and you know, we had a good chat about kind of how the company should be going forward. And I'm not saying that I'm telling him what to do, but it's him telling me like, okay, well, you know, we closed the shares financing, and you know, blah blah blah, and just shooting the shit, I guess, if you will. Is there a better gas stock that we could look at? Like natural gas, you mean? I think Birchcliff is fully unhedged. Journey has a lot of unhedged gas production for their size. i3 has a bunch of gas hedged, but I think it's trading at a better valuation. So yeah, Tourmaline obviously is the stalwart, and yeah, that's about all I can really think of right now. I don't have too many else. I don't focus on natural gas. It's a bonus for my oil companies in a way. With 90% owned shares available are very tight, very illiquid. Yes, yep, you're right, Paul. Yeah, there's only about 4 million shares, I think, that are free float. And I don't know how many people have picked up now from knowing about the company, and those have now become locked until the drill happens. I think after this presentation, there might be people having a longer time frame on it potentially, but I don't know. I've got my shares, and all I can do is share my thesis on it, and the rest is the market decides. What do you think about i3? I think the results were really great. I think it was great. They're doing something similar to what these two companies I've talked about are doing. They're drilling the pockets that people have ignored, reactivations, finding really good geology drilling results. Keep in mind that this stuff like Petro Ninja and all this stuff that allows me to get access to these logs and whatnot, it's a new technology. It's like within the last 4 or 5 years. So these companies now have guys and girls sitting around looking for these spots like with nice logs and nice seismic data and whatnot, and they're drilling some sweet spots. So 2014, the money dried up. This acreage and land just sat there. Well, now it's getting a lot of eyes on them. Not too many eyes, but within companies that already own the lands, they're doing a very good job at drilling good wells above type curve. Yeah, Serenity isn't even priced in. Oh, thank you, Tim. Yeah, that's another good one. Low risk, high reward. I call them high floor, high ceiling bets. You know, the floor is already pretty high, and the ceiling is even higher. So, great. Do you think i3 is undervalued compared to PetroTal? I still like PetroTal. I just want a deal on it. I don't want to pay 70 cents because that's what it was trading at before the social issue, and that's what it's still trading at. I'd rather, if I can get it cheaper, I will. But right now, I like i3. I mean, yeah. Once the dividend goes up, I think i3 will be the place to be. Yeah, it's going to get a lot of support from the UK investors, I believe. Surge presents on May 5th. I think Surge is going to lag a bit, possibly for the next month, given their hedging situation. But maybe people are just looking at this Q3 onwards cash flow early. Like it had a huge jump on Thursday. So the catalyst is there. It goes from making 200 million free cash flow to 350. December 31st comes and we go into January 1st, 2023. It inflects again from making 350 to, I believe, like 450 or 425 a year. What's 425 million of free cash flow at I believe $90 oil worth in 2023? Put an 8 multiple on it. It's basically debt free at that point. We'll put a 6 multiple on it. It's basically debt free. That's a $27 share, $27, $28 share on a 6 multiple. So I don't think Surge is going to be leaving my portfolio anytime soon. As long as the oil price macro stays good, there's no other company that has that much torque, in my opinion. Was Leucrotta on your radar? I like Leucrotta. I just think it was a longer term play. Like they didn't have enough capital to really accelerate development. Now they do. So Leucrotta is going to wait till the end of this year, have them drill the second pad in BC, and then the Alberta pad, I believe as well, and then buy in big time. Because I like the team. The team is the best team you can assemble for a Montney growth play. Now Vermilion has it. Awesome. No complaints. Okay. What effect do you think IT hedges will have given great gas prices? They got 60% of their gas hedged. I believe the pricing is not too bad. So it's gonna weigh down the stock, but what do? You can't win them all. And I think their production outperformance will help them with the gas price boost. I think they're producing way more than they tell us. Like I've looked at some of their new wells and some of the other stuff, like not as deeply, but I wouldn't be surprised if they exit the year, like they say it's 20,000 or something. I think 22, 23, even higher is possible. Maybe, and they're talking about capital increase as well. So they could be at 25, 27,000. Any change in your thoughts on ARC Resources? No, not really. They did a pretty good job with the share buyback in February, I believe it was, or whatever the latest month that got released, March maybe. So yeah, gas prices are going to help them a lot. very poor hedging, but on the rest of it, people forget ARC produces, like people keep forgetting about ARC. It produces, I want to say 1 BCF a day of gas. It produces 60,000 NGLs and it produces 77,000 condensate. They're all doing great. Look at the propane price in the US. Look at butane. Yeah, great. Is the volume of M&A picking up in the WCSB? No, not really, but I would expect to see some deals here in the next 3 months. Some tuck-in acquisitions by companies like Whitecap, possibly in Crescent Point, but also I think there's probably going to be a couple of big shakeups here as well as we go through the summer, and the WTI pricing is really strong. The macro becomes clearer. The whole Russia situation becomes clearer. I think there's going to be some big deals, like $3, $4, $5 billion plus deals. Thank you. Yeah, thanks, KK. Appreciate your kind words. Crescent Point, I've sold everything. Management doesn't get it. Too much hedging. We're going to have them on spaces here, probably in the next couple of weeks or month or so. But Crescent Point and Whitecap, they compete for my dollar. That's the way I've always thought of them in a way, and that's the way I still think of them. And Whitecap gets it, Crescent Point doesn't. Just my opinion. Whitecap has been subdued. Yeah, you're right. Yeah, it'll have its run. It'll have its run. Just like Surge had its run in early January, after sitting there forever, went up 40 or 60% in a month. Is Whitecap going to do the same? Maybe not, but it's going to have a run. And once it starts running, Whitecap's not going to come down. I truly feel that, because a lot of funds are going to have to buy in, and they're not going to sell right away. They're not buying it for a flip. They're buying it to get exposure to the oil sector. Vermilion, I couldn't be any more bullish. That was the one I got called crazy for the price targets I put out. Yeah, couldn't be any more bullish on Vermilion, really. Petrus, I don't know much about Petrus, sorry. Rock Creek might be a good source. Tamarack, big fan. Now I'm getting more and more of a fan of it because it's been lagging. The share price has been lagging, which makes it screen better and better. I do fear that they make another acquisition, a big one, which is why I think the stock is being hit a bit. I do think they make another acquisition, and they have a big, I believe the acquisitions they made were with stock as well. So I think people might be dumping shares now after a 4-month lockup or a 6-month lockup or a 1-year lockup. That did affect Whitecap and Surge also for a while. If Tamarack's still where it is today in a month and everything else has run up, I don't see why it couldn't be in my portfolio and be a pretty significant position with the Clearwater exposure and the buying put hedges, which I absolutely love. Did you learn any macro info? Patrick, I have not listened into that webinar yet. I've been traveling all over and driving a bunch, so haven't had a chance, but I will catch the preview and check it out. Tamarack, yeah. Gear, I don't know much about Gear, honestly. I'm not a fan of it. It doesn't screen very well at all. They are doing some multi-leg horizontals in the Lloydminster area, so keep an eye out for that. See how those come out. Could be a good inflection point for a company making 5,000. You drill a nice 3 or 4 multilaterals making 250 each. Well, you just increase your production by 20%. I only look at Canadian companies. The Australian companies I find there's always something wrong with them. The Australian listed companies, I should say, they got poor hedging, or they can't get debt, or the properties have some problem, or they want to dilute the shares. Like, always something wrong with them. Okay. NG Energy, no, I have no idea what that is. Honestly, there's so many good buys in the Canadian space, so why? I've never looked at these things in detail. NG Energy, Africa Oil, Pantheon, CGX, and all this. Like, it's just, why take on the risk? You're getting juicy yields from stuff trading on the public markets with no risk, no geologic risk, no political risk, nothing. So why? It's like people have this tendency to go into exploration plays. Well, the exploration plays are already pricing in banging wells, and they got huge delays. They're not getting oil pricing today. So why bother? Why not buy producing properties or stuff that's drilling right away with huge upside? Last I heard, Pantheon's well made 20 barrels a day or something. Like, what? In Alaska, which is known for massive, massive production wells, and I know they only fracked one zone or something, but yeah, just not in my wheelhouse. Why bother? i3 upgraded their production. Yeah. Since you're so bullish, Vermilion, why don't you roll some of the calls to out of the money strikes? I think my current calls will make more money. Yeah, because I bought them so cheap. I think they already have the leverage that you're thinking I would get if I rolled them. Yeah, I think so. Because last I calculated, if Vermilion triples from here by December, my calls are a 40x. So yeah, I think I already have that leverage. Headwater drill results, I don't follow it very much. It's trading at like $160,000 a flowing barrel. There's no way. It's not even worth doing due diligence on at this point. I know there's other things that Headwater's doing. They have low ARO and all this other stuff, but I just don't care. When I can get these single well Clearwater opportunity, or single well multilateral opportunities, why go into something that's priced so high? Just my opinion. Yeah, very safe company, very good management in Headwater. Whitecap showed an expansion of 3 million. No, I'm not concerned because there's always dilution with the announcement of Q4 results, annual results. They always have these warrants and options and whatnot. It's pretty normal. 0.5% is actually good. Dilution, that's pretty good. Rubelite, I don't know much about them. They're drilling some nice Clearwater acreage. They only have some in Martin Hill, so keeping an eye out. Grand Tierra, great, very, very high torque. So yeah, if you think oil's gonna hit 150, yeah, that's a name. The options could be some crazy options in there. So I'm gonna end it here with this last question because I gotta go. Thoughts on Journey? Yeah, I think it's still great. There's lots of potential upside there. Again, with the optimizations, reactivations, hitting gas. I don't think I'm going to buy it, no, because I like i3 better for my portfolio. But yeah, it's a great name, unhedged, fully unhedged. So, and I think they beat on production as well. But yeah, thanks everyone for attending. The video will be on in the next few hours on the YouTube and the website. And again, I just want to say everything here is my due diligence. It's my opinion. Nothing is investment advice. It's just what I think and why I invested. I like sharing these things because I like sharing things about the oil industry in general and the due diligence that we do. Learning stuff, learn something about CO2 injection and water flooding and all kinds of stuff. Again, feel free to email me if there's any other questions, and we'll go from there. And everyone have a great Easter weekend.